Secretary of WRC, welcome you all in this GST Relearn series, Relearn Refresher series of the WRC. Friends, we at WRC is highly committed to empower all our members. And in this series, we have set up some goals for this year under the able leadership of our chairman, CR Pit Kabra. And we have decided that we have to perform because we are also entering very nearly, you can say very soon, in a 75th year of our existence. So we have decided to celebrate because this is our pride movement. So pride we have taken as a goal for all of us. P stand for perform and R is for relearn. So this is the series where we are providing relearning in the GST to all our members. And it's really great to have such kind of participation from all the attendees. So with that, again, that I stand for innovation. So we are doing a lot of innovative work during bank audit also, and apart from other activities which we are doing, where technological innovation is integrated, and we are trying to have some, you can say, a better approach to reach to the members and better content, and how we can take benefit of technology
I think there is some
in our day-to-day networking work which we are doing. Am I audible?
Yeah. Your network is a little bit lagging, Saurabh sir.
Yes, sir. Saurabh sir, yes.
So then E stand for enrich our ecosystem, where we are trying to have social audit, ESG, and you can say BRSR reporting, which is required for top 1,000 companies now in India. So at WRC, we are trying to have all the programs related to all the topics for the benefit of our members. And in this series, we are doing this program also. Now I request CA Sahil Jain, coordinator of this program, to introduce the faculty of the session, CA Rajat Talati ji.
Thank you very much, sir. So now I would like to introduce our first faculty, CA Rajat Talati sir. He is a very distinguished personality and has an experience of more than 30 years in the indirect taxation. He is a chartered accountant of 1986 and leading the indirect taxation of his firm, Talati and Company. He also blessed ICI and as well as WRC with his extreme contribution, academic contribution in all the fields. From 1999, he has been the secretary of Federation of Tax Practitioners for 3 years, from 1997 to 1999. So we are blessed with such a great personality to hear today. And apart from academics, he likes trekking and all the things, and he likes to enjoy the mountains and beaches. That's all from my side. Welcome, sir. Welcome, Rajat Talati sir, on the behalf of whole WIRC. I welcome you all in this session. Thank you.
Thank you, Rajat sir. Over to you, sir. Thanks for your time.
Yeah, thank you very much. At the outset, I express my sincere gratitude to the Institute for having invited me again on this platform. See, addressing at WRC is like playing on the home page. It is always having a home advantage that you feel at home, and that is what is here. Today, I am going to speak on the bulk trade business. Now, what in this relearn part, what we are trying to revisit is the subject or concepts which we come across on a day-to-day practice, but having some peculiar implications under the GST, so that what happens is our focus is more on learning those concepts again, or trying to put those concepts in the practical scenario and interpret the situation and the tax implication thereon. This is kind of a sectorial knowledge sharing session where we are going to talk about bulk trades. Bulk trades means what? So the agenda that I have today is quite elaborate. We will talk about the overview of the bulk trade business that I talk about, the different elements of sale price and the valuation issues which can be encountered, typical business transactions or models that this industry follow. Some problem areas, issues in import and export and the related refund thereof. Ocean freight, the RCM payable thereon is also an area of concern. Some ITC related pressing queries, not the ordinary one, the pressing queries in ITC we will also touch upon. The idea is to highlight certain issues, try and give you certain possible solutions to it. It is quite possible that every solution which is discussed about here may not be the complete solution. It can be subjected to the regulatory acceptance at a later date. Nonetheless, today we discuss about is an academic discussion where one should be able to know the possible pros and cons of a particular set of understanding that we have about the facts, as also about the provisions of the law. Of course, taking consideration some set judicial pronouncements on the same, or some other judgments that are available, or the clarification issued by the GST Council on such subject. So this is what is the background. Let's go on to the overview of the business called bulk trade. Now, what are we talking about? Bulk trade is something like a simple wholesale business. Yes, it is a wholesale business with is in the large volumes. Large volumes means the transaction ticket size is also large. The business volumes are also large with thin margins. What are we talking about is agri-produce like cotton, oilseeds, including wheat, pulses, minerals and ores, chemicals and gases, liquid cargo in bulk, in tanker, stored in the tanks, cement, steel, etc. So these are the bulk commodities which are traded in large volumes. Now, of course, being a large volume trade, a slight slippage may result into quite a large exposure in the business, and the margins are so thin that such mistakes can be really what we call having a very large financial implication or impact on the business. Such businesses are done on not a truckload basis or a wagon basis. They are basically rail, full racks are considered, and the entire rack of the railway is the cargo size, or we are talking about entire charter ship or the containers of loads which is being shipped. At times the procurement happens at the agricultural produce mandis, we call them, or the mines or large importers who trade into it. So it is quite possible the large importer would make a full load of sales to another large player in India. Government agencies like Cotton Corporation of India or MMTC or MMT or SAIL, etc. also do a large volume of business. So we are talking about such contracts where the transactions of large sizes, large ticket sizes take place. Normally, this is done by large Indian corporates, multinationals, Indian multinationals, as also subsidiary of foreign multinationals. So these are large international players. Indian players are also large in the international trade. So these companies do such kind of businesses. So we are going to take the study today in respect of these large businesses. Of course, at times we have smaller businesses also encountering the same size of same type of situation and the GST implications to be understood. So such transaction may have implication for smaller businesses also, but nonetheless they are attributable to large business. So hence the term bulk business. Let's talk about quality allowances. Friends, when these businesses are undertaken and for any kind contract is entered into, so large purchase orders are placed or contracts are entered into for agreed amount of supplies at a later date, etc. Whatever it is, there are quality terms given in the contract. So these quality terms also provide for some allowances, like let us say 0.5% of the moisture contains is acceptable, and if there is a 0.55, so it is higher by 0.5%. What would be the fallout thereof? So in such case, the first question comes in from the GST point of view is accepting the cargo with, in our example, say 0.55% of moisture content instead of 0.5 with a tolerance limit of, let us say, only 0.2, would that amount to tolerating an act? Now, friends, we do have a circular now issued by the CBIC on the liquidated damages, etc., or the compensation. Now, once again, I'm referring to that only. What is being said and what has been understood in the businesses, in the common business agreement, is that you have the agreed tolerance limit of the quality, beyond which there is a mechanism to work out the rate. Now, this rate is to be refixed based on the quality of the goods which is received. Now, would you say that the buyer has tolerated the act of the seller not sending the material with the quality which was expected from him? If the contract provides for a mechanism to refix the price, refix the rate, if the goods come of a quality little below than what was envisaged, would it amount to act of toleration? To my understanding, this would not. This is nothing but refixation of price based on the contractual term. Or one may say that this is sort of a compensation for the lower quality of the material accepted by refixing the price, by recalculating the price. And for that reason, it is not an act of tolerance and should not be considered as a supply under the GST, attracting GST. The next point comes is arbitration award. Now, in such cases, there are at times both the contracting parties do not accept the claim made by the other side, or they do not reconcile the amount of compensation irrespective of the terms which are provided, and the arbitrator is appointed and the award is received. Typically, there is a time gap between the award of the arbitrator and the original supply. Obviously, this would take some 6 months, 12 months, as the case may be, whatever it is. So during this time gap, it is quite possible that there would be the flow of compensation or the debit note, credit note, as we call them, at a later date. Would it have any GST implication? Now, what happens is the order, when it is given by the arbitrator, is at a later date. The provisions regarding the issuance of debit note and credit note clearly states that you have to account for the debit note or credit note in the month in which these are issued. That being the case, such time gap would not have any implication. Now, if I were to say that this credit note is issued today for a transaction which is 1.5 years old, because after the arbitration award, this was challenged and we went to the High Court. And the High Court is finally given the verdict, and that has been accepted by the contracting party. Now, this has taken a little longer. Now, say 1.5, 2 years have gone. And the time of claiming ITC of the same has elapsed. Two things have to bear in mind. If there is a reduction in the price, then what was originally billed for, in that case, there is reduction in ITC, and for which there is no time gap, time limit prescribed under section 36(4) or 16 rule 36(4) or section 16(4). So there is no question about it. But if I were to claim little higher credit now, if there is a verdict which says that no, the amount payable is higher by the recipient or by the purchaser, in that case, I will be claiming more credit if in the facts of the case. In that case also, I will be covered by the provision to say that today the debit note is issued, and for that reason, I can claim the credit thereof in the month in which it is issued to me. There is interesting decision of the Maharashtra Sales Tax Tribunal in case of Western India Coalfield. It is not Westerner, it is Western India Coalfield, where the tribunal says that the transaction dates back to the original date of supply. Now, would it have any implications in the current scenario where we have a provision of debit note and credit note, which says that you can claim the credit note in the month in which it is issued or the debit note, and you have to disclose the liability in the same month? Will this tribunal decision have any impact? Friends, the tribunal decision has said because there was a question of paying interest thereon on the additional amount. So the issue was, if that transaction date backs to the original issue, the interest would be attracted and fair. The reality of the facts is that yes, the transaction date backs, but my provision under the GST Act allows me to raise the debit note today and account for this same. So when I say debit note, I should not be paying the interest. That could be a little far-fetched. However, at least claiming of ITC, this provision will help me. Let's go to the next point, the quality difference. So that could be the loss arising, or quantity difference, the loss arising out of the normal loss or abnormal loss. Let us say the handling loss is accepted as 500 kilogram for every ton. And if that is the handling loss for, say, handling cement bag, every time the cement bag is handled, there is a loss of some cement because of the bag being put on the floor from the head of the worker who carries it on his head. So every time he puts the bag on the floor, there is some loss of cement, and that is, let us say, considered as 500 grams for every 1 ton, which is a normal loss. Now, there could be abnormal loss. There is the truck which is carrying the cargo has met with an accident, and it toppled, and there is some loss of goods. The issue is in respect of the ITC in such cases. Friends, I will be talking about sale price, ITC, everything together, because ultimately we are to see the implications from all fronts. When there is a normal loss, would there be any impact on the pricing? The normal loss, the price is already factored considering such loss. So there is no challenge. When there is an abnormal loss, the quantity dispatch is short received at the recipient. So the sale to that extent is not complete. There is no transfer of property resulting into the entire quantity. So sale itself is not complete to the extent of, let us say, 500 kilograms which got lost in the accidental damages. So if that be the case, to the extent of 500 kilograms of such abnormal losses, there will be a credit note issued. My sale price will have to be reduced of the invoice to have been reduced by the extent of 500. Now, what happens in the hands of the supplier in such case? For the normal loss, there is no question of valuation. For the abnormal loss, we talked about the credit note to be issued for the quantity which is short supply. Such short supply of quantity results into permanent loss of those goods. That being the case, such short quantity lost, the corresponding ITC of such quantity will have to be reversed in the hands of the seller. In case of buyer has received less quantity out of 1,000 quantity, now is received, say, 500, out of 10,000 quantity is now received 500 less, so say 9,500. He has received 9,500, he has paid for 9,500, so he will be eligible to claim ITC of only 9,500 quantity. At times, when there is a handling loss, etc., or there is a loss because of the transporter's mistake, or transporter, the contract is, let us say, if it is, say, packaged commodity is going in bulk, and there is a glass bottle which contains, and there is a normal breakage allowance of, say, 500 kgs for dispatch of say 600 cases, 500 bottles for 600 dispatch of 600 cases. If the breakage is more, some amount is received from the transporter. What is going to be the implication under GST on this account? So what happens here is the entire sale price, whatever is quantity received, is to be realized from the buyer. To the extent of the quantity which is in excess of the agreement with the transporter is deducted from the transporter's invoices. So the seller realizes his sales proceed from two persons. One, the buyer to the extent of quantity received, and from transporter qua the excess amount of breakages in this example. So in that case, the GST is payable by the supplier on the entire amount of transporter's receipt as well. Now one would say that is it not my liquidated damages which I have agreed upon with the transporter? It is not transporter that I was to pay him, let us say 7,000 rupees for the dispatch of cargo from place A to B. Now I'm paying him only 500, 6,500. I'm recovering from him as a sort of under the contract for destruction of goods or higher breakages. Well, that is a very strong and possible argument. And I will also agree to it, saying that this receipt is coming from transporter as not my sales proceeds. This receipt is coming from the transporter qua the contractual obligation that the transporter has under the contract of transport. And for that reason, I am still strong on my views to say that this is a kind of a liquidated damage, is not attracting the GST. However, in such cases, the GST officers are normally inclined to say that you have received consideration from two persons and hence it is taxable. Friends, I have a very strong opinion saying that this would not subjected to GST. Transit insurance. Now, always this cargo is normally insured for its transit. We call them marine insurance. So when you have certain claims being made on the insurance company, you do receive the insurance claim. Now, would such insurance claim attract GST? Once again, what was the contract entered into with the insurance company? Saying that this is the cargo which is insured, and if there is a loss, the insurance company has to pay, provided I pay the insurance premium for the cover which I buy, the insurance cover which I buy. So that is the consideration for an insurance contract. Under that contract, the insurance service is provided by the insurance company. I am the recipient of that service. Under that contract, so transit insurance which is now received is that obligation under the insurance contract and not a consideration for supply. So there is no supply for a consideration, and hence that insurance would not be subjected to any GST. Now, would there be any liability or implication for reversal of ITC? Friends, what happens is such normal happens because there is a loss of cargo, maybe because of the cargo getting lost in the accident, or because of the rainwater seeping in the and destroying the cargo or impacting the cargo's quality, which is becoming non-sellable, etc., etc. So in such case, is the ITC reversible? If the facts are that which suggest that these goods were lost, are not capable of being sold further, in that case, ITC to that extent is to be reversed. Now, one would say anything can be done to save this kind of a reversal. friends, one will have to see what is the salvage of that cargo. Normally, insurance company will say, let us say your insurance claim is say 20 lakh of rupees, but the rain affected cargo is worth 3 lakh of rupees. So I will pay you only 17 lakh, 3 lakh of worth you realize by selling them in the market as salvage value. One thing one will have to see, what is this salvage? Is this salvage on account of the scrap value, or is this salvage on account of the deterioration in the quality of the material? If I say that this is deterioration of the quality of the goods, in that case, the goods are still sellable. Maybe it is fetching much lower value, just say 15% of my value, or say 30% of my value. But still, that goods are still sellable. In that case, their goods are not lost. If that is the facts of the case, then IT is still available. But if I say that that salvage is nothing but piece of scrap which I'm realizing it, so one will have to see the accounting entries which we pass. If you were to see section 17.5, if it is written off in the books, in that case, ITC is to be reversed. So if it is scrap, you write it off that quantity in the books and realize the scrap thereof. In that case, ITC will have to be reversed. Friends, going further in the elements of sale price discussion, there are at times price variation clause. If I'm, let us say, dealing in copper, and I have linked my price with the supply schedule over a period of time, and my price is linked to the price which is given at the London Metal Market, Metal Exchange, they call it LMC, London Metal Exchange. So if there is a price which is linked to that, and today if there is a price which is charged, and I decide the price later on considering the price prevailing at the London Metal Exchange, such differential price element will increase or decrease my contracted sale price, and to that extent my liability to pay GST would also vary. So this typically happens when the bulk quantity of cargo keeps moving in, the truck after truck goes, and the delivery challens are made, the invoices are made at the standard contracted rate, and after the period end, there is a agreed system which is entered in, which is accepted by the contracting parties. They say that every quarter, every 15 days, we will have the actual price being redetermined based on the price which is there on the London Metal Exchange, and accordingly debit notes and credit notes are issued for the price variance. So that is how the price is reinstated to a correct price by issuance of the debit note or the credit note. So the GST liability would also increase or decrease accordingly. Friends, am I going really fast? Because I realize that time or later on, few of my friends do come back to say that you are too fast, but I do not know today. Sahil, is it okay, or am I going fast?
No, sir, it is okay. You are little bit slow can work.
All right. I'll try and amend. Okay, thanks.
Yeah.
So there are certain types of recoveries which are made in such cases. Now, these recoveries, why I say? Because my sale price is agreed. There was a term say that I should pick up the stock, or rather the buyer should pick up the stock in next 7 days. Now, buyer has to arrange for a fleet of trucks or tankers to arrange the pick up the delivery. Let us say 500 tons of cargo, or say 1,000 tons of cargo. So multiple trucks are multiple trucks making multiple trips are required. So what happens is he takes, instead of 7 days, he takes say 10 days to pick up the entire stock. So the sellers go down, is occupied, his sale price is not realized. So there is a loss of some kind of opportunity at the seller's end. So seller collects something called as carry charges. This has basically two elements. One is the inventory carrying cost, and two is the sort of an interest element in case of the delayed pickup. And for that reason, the credit period will start when the delivery is taken. So in both cases, something called carry charge is collected, and that is also factored in the contract. Warehouse charges, we know, warehousing charges are also collected. What happens once again, if I am saying my rate is spot today, and if you receive, you take the delivery after 20 days. So for 20 days, I am storing goods on your behalf. So 20 days ka warehousing charges are also collected. Packing and forwarding, it is a standard term. Transport, once again, a standard term. Now transport, there is another slight variation which is possible. Large players, let us say, who is say distributor of say Tata Steel, what he would do is he has a price which is standardized, so-called catalog price, and depending on the distance that he has to carry the goods for delivery, he fixes up certain additional amount, and he quotes, let us say, 100 rupees for a particular quantity. Now the buyer comes and arranges for his own transport. He says that I will send my trucks for picking the goods. So the transport element from my sale price is given as sort of a discount. So the invoice appears 100 rupees, 2 rupees as transport discount, and 98 rupees on which he charges GST. At times the GST officer also raised a question, why is this discount of transport? Is it not that you are this being a part of your obligation you are transferring to him? So my sale price is only 100 and not 98. Friend, once again, one will have to see how the contract got negotiated. Contract was 100 rupees if I were to deliver the goods to your place. So my obligation was to deliver your stock to your place only when I undertake and calculate my price at 100. But if you do the same, you get 2 rupees discount and you pay me only 98. So that means there was no obligation of either side to transport the goods in a manner which is otherwise understood. So when I say 100 rupees, it is seller's responsibility. GST is payable 100. Agreed. If it is 98, it is not seller's responsibility. It is not his obligation. So section 15(2) would not operate. So the GST is payable on 98 rupees. APMC says, when you have agriculture produce, you have agriculture produce market committee cess. Now this cess is collected. Now what is this cess? One will have to understand the nature of this receipt. APMC cess is the cess which the seller has to pay, so has to be part of the mandi from where he makes this sales. So this is his element that enables him to make sales from the mandi area. Now mandi area is not necessarily mandi proper, but the vicinity where it is applicable, the mandi cess is applicable. There is a notification in all these cases which defines the area. If your godown also falls into that area, APMC cess is payable. So that cess is recovered from the customer, and that is how it becomes part of my valuation under section 15. Interest on delayed payment, there is nothing new. We don't talk much about it. Scrap sale. Now this is very peculiar. At times, these large players buy crude edible oil and give it to the refineries for refining it. When they fix the job work charges, there are two ways of doing it. One is you refine this oil, whatever is the scrap generated, you give it to me. I will sell it. So whatever is the job work charges is this valuation for the purpose of GST. whenever I make the sale of the scrap, I will be selling the scrap and realize the tax payable thereon. No challenge. At times, the job work charges are determined considering the fact that job worker will retain the scrap which is generated in the exercise of the job working. So refining का जो scrap generate होगा, that will be retained by the job worker. So job worker, initially he said that he will charge, let us say 1 lakh rupees for a particular quantity. Now he charges only 95,000. So the issue is whether the job worker, what is the valuation in the hands of the job worker for such transaction of the labor charges that he carries out. In this case, the valuation is that job worker has two elements. One is monetary consideration and another is non-monetary consideration. Monetary consideration is 95,000. The non-monetary consideration is the scrap fees which he retains with himself. So that 5,000 would be notionally added to the valuation of 95,000 and the GST is payable on 1 lakh. Friends, such cases have been reported in the service tax era also. So considering that, one will have to take the valuation. At times, empties, gunny bags are emptied and the cargo is given in loose. So that gunny bags are retained and there is a recovery thereof. So if valuation is factored considering the recoveries of the empty bags in our example, that will be factored in the pricing. So friend, what happens is one will have to understand the contractual obligation and under what circumstances these different types of recoveries are made by the seller from the customer, and accordingly considering the nature of the transaction, one will have to decide whether this will be subjected to GST or not. Now let's look at some typical transactions. Transaction on commodity exchange. We have multi-commodity exchange where the contract for forwards deliveries are also entered into. So what happens when I make a contract for forward delivery? I say that on the 5th of next month, I will pick up 10,000 kilograms. Now this 10 tons of cargo I have to pick up on the 5th of the next month. On that day, at the agreed rate, I will make the payments and take the delivery of the goods. So there is no challenge there. It is simple delivery, actual delivery is taken. The seller will cut the invoice in my name and he will charge the GST on the agreed sale price, which is as per the contract. At times there is a rollover. What happens is I, as a buyer, will say that, look, today I am not able to take the delivery. Let's roll over this contract to the next 15 days. So now I will take the delivery on the 20th April, my forward contract for the next contract period after rolling over to the next 15 days. So this is known as a rollover. So what actually happens is that my original contract is cancelled and a new contract is entered into. There could be some rollover charges, which the buyer in our example will have to pay. At times even seller pays. If seller says that I am not able to effect the delivery today, I will give you delivery after 15 days. In that case, the rollover charges are paid by the seller. Whatever is the case. And at times there is a perception that the price will fall. So the buyer will say that today I do not want, but I will want to take the delivery later on. The seller says, today, if you take it, you are going to pay me 100 rupees per kg. And after 15 days, you are going to give me at 99.5. So there is a loss of 0.50 paise. So there could be payment by either side, buyer or the seller in this particular case, depending on the facts of the matter. Is this rollover charges subject to GST is the question that we have to look into. These rollover charges are nothing but contractual obligation. Once again, I will be time and again referring to the contractual terms. This is the way the contract is rolled over to the next period. These are not act of tolerance. No, these are terms of the contract. The rollover is also based on the commodity exchange regulations, which allows the rollover. So these are, because contract is always entered into as per the regulations of the particular commodity exchange. So this the contract cannot be beyond that. So the commodity exchange also provides for a mechanism of rollover and the structure how it is to be computed. So that being the case, this is nothing but part of the contractual obligation and no GST should be attracted. Square of transactions. What happens is, I am to purchase, let us say on the 5th of May. From today, the contract maturing on 5th of May, say 10,000 kilograms of say cotton, or 10,000 bales of cotton. That is the correct example. I believe that 100 rupees price which I have contracted on say 5th of May morning, I have a market reading which says that this price is going to fall substantially over a period of time. And I do not want to even risk myself to roll over to the next period. I'll simply square off. I said, oh, okay, I do not take the delivery. I square off the transaction. I walk out of the contract. So the contract provides what is going to be the payment made by the person who walks out of the contract. Now, in such case, such squaring off of the transaction would result into compensation being paid by A to B or B to A, depending whosoever is the contract who is paying it. Coming back to the same logic that this is the contractual term which is being honored, such compensation received or paid would not tantamount to any supply under the GST and no GST payable. Why no supply? Because there is no consideration for the supply which is agreed upon. What was supply agreed? To sell 10,000 bales or to purchase 10,000 bales. That was the supply transaction for which consideration was agreed. Consideration was not agreed for closure of the contract. The closure of the contract or walking out of the contract was one option available under the contract which provided for a mechanism, and there is no consideration for such supply, and hence there is no GST payable thereon. At times, and there is another strong argument to make for such compensation received or paid. These commodity exchanges, these transactions can also be termed as a transaction in security. If you were to consider the what is this regulation? It is future. What is that? Future market. I just missed out that enactment under which these transaction of entering into a forward contract is considered as a security transaction in security, and for that reason also one can surely argue that this is not a supply, because transaction in security is not a transaction, is a supply transaction, and hence on that count also one can surely argue that no GST is payable thereon. Now, sorry, the washout transaction is also similar to the transaction. Now, when I square off the transaction, it is also known in the market terms as washout transaction. Now, washout transaction, what I do is against the sale contract or forward, I enter into a purchase contract with the same guy on the same date on spot basis. So this is how I wash out the transaction, sale against purchase transaction, and I close the matter. So this is also a mechanism available, and this is surely not an act of tolerance as per circular number 178, which I have been talking about all this while, dated 3rd of August 22. A very wonderful transaction, a wonderful circular which is having clarity on a lot of issues being misconceived as act of tolerance. One simple example being the leave salary cut from the employee who is leaving, giving shorter notice period. I mean, not leave salary, notice period, salary which is recovered. So that is how this particular circular has touched upon good important aspects of the understanding of the phrase tolerating an act, because here there is no consideration for the supply, and hence it is not a supply. Right. Now we go to the transactions of high seas and bond sale. Now we have to divide this transaction into two parts. The transaction entered into before 1st of February 2019 and transaction later on. Let's talk about period prior to 1/2/2019. Why I am saying so? Schedule 3 has two paragraphs, 7 and 8, talking about the transaction of high sea sales and bond to bond. Schedule 3, friends, as you know, talks about transaction with neither supply of goods nor supply of services. So they are outside the taxation purview of the GST. When we talk about Schedule 3 and high sea sales, we must understand high sea sales are one where the goods are sold by the seller to the buyer before the goods have crossed the custom frontiers of India. What is custom frontiers? Custom frontiers, as per the Customs Act, means the goods which are the place where the goods are ordinarily kept before export or before import. So before export taking place, the goods are kept at a particular place, and before it is cleared for the home consumption. So the place where it is kept before the clearance is the custom station. So once you file the bill of entry for home consumption, you have crossed the custom station. So the transaction where there is endorsement of bill of lading by the seller in favor of the buyer, and the buyer files for the bill of entry for home consumption, such transaction in the hands of the seller is known as high sea sales. So what happens is that on 1st of February 2019, effective 1st of February 2019, Schedule 3 is amended and have categorically said that high sea sales transaction is not subject to GST because it is neither supply of goods nor supply of services. What is bond to bond? When the goods are imported, the importer has two options. One, to pay the import duty and file for bill of entry for home consumption. Or if he does not want to clear the goods today, for whatever reasons, he can give a bond of the customs duty amount and store the goods in a bonded warehouse, and he files for bill of entry for warehousing. Such bond is given, and the warehouse, which is notified as a bonded warehouse, the goods are stored. So there is a possibility that the imported goods which are in bond, the seller wants to give it to the another person who will keep these goods once again in the bond. So it is known as bond to bond sales. Such category of transaction for a period prior to 1/2/2019 was having quite a peculiar situation. This was termed as exempt supplies because of the judgment in case of BASF. We say that this is case of an exempt supply. Now, what happens is that decision correct? That is also one big question that we have. If I say that it is a question of a turnover of sale which is exempt supplies, in that case, would I be required to reverse input tax credit? Because section 17(3) with the limited definition would make it possible for reversal of ITC saying that this is an exempt supply. Now, that being the case, there will be a case by the revenue to say that you will apply Rule 42 and reverse the ITC qua such exempt supplies, because exempt supply also includes the non-GST supply. So post 1/2/2019, prior to 1st February 2019, there was a challenge in respect of the reversal of ITC. Please note, Finance Act 2023 has amended paragraph 7 and 8 of Schedule 3, which clearly says that this is to be made effective 1st of February 2019. So to that extent, the entire controversy get resolved. However, what has happened, the act has passed, but this particular provision is not made yet effective. The practical reason is very simple. This act will have to be given effect to by the states also. And for that reason, of course, this is an amendment to the CGST Act. So similar amendment will also have to be made under the respective state GST Act. And for that reason, the effective date would be notified much later when all the states do pass their amendment to the respective state GST. So of course, this will take some time, but till such time, the revenue may take a plea that although the enactment is passed, there is no effective date announced for such such clause of the amending act, and for that reason, the liability is still there. So we will have to live with it, with this litigation for some more time. Now, bond-to-bond sale and ex-bond sales, there is a circular issued under the customs, number 46 of 2017. Now, what has created this difficulty is this particular customs circular was talking about a situation when A sells to B, B sells to C. Now, A being the foreign exporter, he has sold to B, who has stored the goods in bond, and B sells to C once again in the bond. The circular states that this will have to be, the GST will be attracted at all stages when A sells to B and B sells to C. Of course, the recipient will be eligible for input tax credit, but nonetheless, the liability will be at the multiple level. So if C were to sell it to D, he will also be paying the tax. Now, when D clears for the what we call he files for bill of entry for home consumption, this transaction known as X bonding. When he clears for X bonding, that time he will file for bill of entry for home consumption. He will pay IGST on such imports, sort of imports. So all these cases are creating multiple levels of payment of IGST, claiming of IGST as an ITC. However, the circular is issued effective 1/4/2018 under IGST, circular number 3 of 2018, dated 25th of May, which say that this the GST will be payable, IGST will be payable only by the person who clears the goods for home consumption. So one who files for the bill of entry for home consumption, he is only liable for payment of GST, and earlier transaction is not. So that being the case, all the earlier transaction is exempt sort of from the GST. When I say exempt, once again, 17(3) will be read. ITC reversal, qua this transaction would be subjected to the exposure. One would say, for this particular transaction, there was no tax paid on the input, so there is no reversal of the tax qua that goods itself. However, common credit can be exposed in such situation, applying the ratio of Rule 42. Now, there is another large volume of transaction which is known as merchandising trade or merchant trade, or we commonly call it as out and out sale or drop shipment. These are the different words which are being used in the industry. What happens is, let us say cargo is moving from Dubai and going to say Singapore. Sitting out in India, trader A will sell it to trader B who is in Singapore. Now the goods do not touch the Indian shores at all. So there is no question ever of these being treated as import of goods in India. So such transaction take place outside the territorial limits of India. In this case, the entire transaction is not the subject matter of taxation under GST at all, because they doesn't fall into the GST. The synthite industries, there is a AR of the Kerala which says that yes, we agree there is no GST payable, but they hinted for reversal of ITC here, saying that this is an exempt supply. Exempt supply, the term is so wide that it also includes non-GST supply, and hence such cases there would be a reversal of ITC for the common expenditure. Now this is where we have further decision, INA bearings, which also said there is no GST payable. However, appellate advance authority of Gujarat has held that it is subject to GST. Of course, all advance rulings have only persuasive value and not binding effect on the particular SSE. Of course, we as student of law, we have to take guidance from these decisions to understand the point of view of the revenue, point of view of the others in the industry, to understand the GST implications. So this is what we have to take it further. Now, liquid cargoes, we have a situation where the delivery is given X tank. Now, let's understand these tanks are large. They let us store say 100 tons, 200 tons, or say 500 tons together in the same big tank. It could be crude, crude oil, or it could be chemicals which are imported in bulk and pumped into these shore tanks. It is times these goods are commingled goods. What I mean commingled is, the cargo of 4 or 5 owners could be stored in the same tank, because this is liquid cargo, it has to be emptied. So the cargo is pumped and emptied in a storage tank where 3, 4 traders, 5 traders have the ownership of the cargo. Let us say if it is storing 5,000 tons, 3, 4 customers will be having the ownership of the goods which is stored at the tank. The tank owner gives receipt voucher to all the 3, 4 people of the respective quantities which is unloaded in its storage facilities. These goods are homogeneous, of the same type, so they are commingled, because liquid cargo cannot be identified unless you take it out and put it and segregate it. Under Sale of Goods Act also, the transfer of property will take place only when you take out the quantity from a common cargo and ascertain the cargo. Till such time it is an unascertained cargo. However, they are commingled goods, similar goods stored together in the one tank. So they are sharing common storage by different suppliers. So what is the place of supply if there is a transaction? A enters into a transaction with PQR and company to say that out of my 500 tons which I have, 200 tons I am selling it to you. PQR says, all right, I buy this cargo. I will write to the tank owner, tank facility owner, or the warehousing keeper or tank warehousing keeper, to say that out of these 500 kilo, now 200 kilo belongs to me. The seller will also endorse that. And that is how in the records of the tank farm or the tanker owner, he will mention 200 against the name of PQR. What is the place of supply? Please understand, there is no movement involved in this case, and for that reason section 10(1)(c) will apply, and the place of supply will be the place where the goods are stored. At times, what happens is when this cargo is huge and is kept for some period there, some cargoes, maybe say edible oil, or for at times some crude oil, develop certain impurities in the cargo, and that sludge is either floating on the top or it settles down in the bottom. So the person who takes the delivery of the cargo at the later stage has also to take the sludge as part of his cargo, because everybody's sludge is now accumulated at the bottom and he has to take it out. Now, what happens to the seller who has said that I will deliver you 200 kilograms? I mean 2000 tons out of this total quantity. So actually on the day when I enter into a transaction of sale and have reported this transaction as a seller to the tank farm, and the buyer has also acknowledged saying that you keep the stocks in the name of PQR in our example. Now PQR is the person who has to take the delivery. It is his ownership of the goods. The ownership is transferred, and for that reason, that was agreed between the party that uncertain cargo is also taken by me as my ownership. PQR is the sole person responsible for such sludge. So he will have to bear the impurities which comes along with him when he takes the final delivery. Now the sludge is sold. What is the rate of tax payable? Now when you say sludge, such sludge has some element of edible oil or say crude oil, which is possible to take out from that sludge. So the sludge has value not of the scrap, but has much more value than the normal scrap one would realize. For that reason, in my understanding, the sludge will also bear the rate of tax of the goods which it represents, because it is capable of taking out certain more. Of course, the price it will fetch will be lesser value, of course, to the what we call the clean cargo or the correct or pure cargo as we call them. Now, as we talked about the large transactions, what happens is, let us say I'm selling 5,000 tons of cargo of the tank, and at the transaction ticket value is say 5 crore rupees. I have entered into a contract of sale and I have informed the tank owner also that look here, I have sold this 5,000 tons at 5 crore rupees to PQR. But PQR has not paid me entirely. So what happens is, at times the contract is entered into, which says that although the contract of sale is entered into, I will allow you to take delivery only when you pay me. So today, if you pay me 50 lakh of rupees, I will allow you to take delivery worth 50 lakh only. When you make another say 75 lakhs, I will allow you to take delivery of 75. Now there is a challenge here. Passing of property vis-a-vis the risk which is associated with it. When I enter into a sale and the sale invoice is cut for the entire 5,000, what happens is this entire 5,000, the sale is complete in a way, because I have already informed PQR that you are owner. PQR also wants to raise finance against the same. So PQR will also pledge the stock with the banker and raise the finance. But since the seller A, he is not received the cargo, what you call realize the consideration, he is not letting the delivery thereof. Now, all these cases, what happens is the liability under GST Act will have to be examined. The sale is complete because I have to report full sale. The buyer will have to report full purchase. He will claim the entire ITC and he has to pay over a period of the agreed credit terms. And agreed terms will not be more because he wants to take delivery and only and pay and take the delivery. So credit terms are also not long. For that reason, he has gone to the bankers to raise the finance, or he has gone to some financing company to raise the finance. So in all these cases, the business risk or the security of payment, etc., comes into place, and the delivery orders are given by A only to the extent of the amount which is realized. If the contract is designed with a very clear intention to say that, look here, the transfer of property will take place today, so that PQR can place these goods and raise finance, the GST liability will be starting today. My liability to issue tax invoice will start today because I'm effecting sale today. But if I say that I have entered into a contract which enables you to take delivery only on payments, in that case, the day which when I receive the payments, I have freezed my price as per the contract which allows installment deliveries. My transfer of property or my sale transaction will take place over a period of time on the realization of consideration. In that case, my payment of GST liability would also stagger over a period of time. So one will have to see how the contract is drafted in particular case. Conduct of the party is also very relevant and important. Now, merchant export. So we have GST concession rate of 0.1%, where the buyer undertakes to export the goods within a period of 90 days. Friend, the notification number 40 of 2017, which allows the concession rate of tax to be charged in a case where the exporter is buying these goods to fulfill his export obligation, there are conditions which are given. Please understand, all these conditions are cumulative conditions. And one miss and the seller's claim of concessional rate can go for a toss, and it can attract the full rate of tax on the commodity. If the commodity attracts 18% tax, the entire 18% can come, which is a very peculiar condition which is observed, is slipped or missed by the contracting parties here. One being that when there is an order placed, the exporter, the exporter's officer is also to be informed by the supplier that this is the purchase order which I have received, whereby the exporter has undertaken to export within 90 days of its purchase. This is the export. So the seller has obligation to inform the exporter's GST authority, GST officer. Now that is one condition which is normally missed. So we have received several such what we call notices nowadays for such miss outs, and these technical lapse is being treated as not fulfilling the conditions given under the notification, and the claim is being subjected to tax. So please bear in mind, this is very strict condition needs to be fulfilled. Now, what are the chances of this being argued in appeal to say that substantive compliance is made and one technical lapse may not lead because there is no loss of revenue to the state? Well, this is a very litigative approach. One can take a very strong case and build up this saying that substantive compliance is made, and for that reason there is no loss of revenue to the state. If I were to charge 18%, the exporter would have realized the export of goods, and for that reason he would have got the refund of the tax paid on the inputs based on the exports that he has made. Well, the argument is good, but still litigative, will have to go, to my understanding, at least to the tribunal. And if some cases by then are available from High Court, etc., one would not be, one would be spared from going to the High Court for one's own matter. Otherwise, this is going to be quite litigative. Friends, in past, we have several conditions, maybe in excise, certain notification benefits were claimed, in customs also notifications are being claimed, and they have been viewed very strictly, because the concept is to claim benefit under a notification, the entry for claim of notification benefit should be strict. Having qualified for such notification benefits, it should be liberally interpreted. Now, intimating the officer about the purchase order whereby the exporter undertakes to export, would it be a very strict compliance, strict condition which prohibits my entry for claiming of notification, or it is a procedural compliance which should be interpreted liberally? That is the question. If I say and interpret the notification, the significant and the important underlying condition is exporting the goods which is purchased by the exporter within 90 days. Now, this is very, very strict condition, but for which I am not eligible for concession. Other conditions of intimation to be given to the GST authority, etc. What are these intimations? These intimations are to secure that there is no misuse of this notification and there is total oversight available, monitoring available of such transaction, so that buyer and seller do not play mischief and take undue advantage of the notification. If I say yes to this, then this becomes only a technical or procedure compliance and should be understood to be a part of liberal interpretation of the notification, and I should be allowed the benefit of the notification. Well, I said this is the line of argument one can make it, and I wish you all a very best of luck for that. But as of today, at the adjudication officer level, he will disallow it. We'll have to take it up in the appeal. Now, I mean, at this level, it is difficult for a officer to accept this proposition, unless even if we were to give the entire category of decision of how to interpret a notification, how this or we can give certain examples of past judicial pronouncements. It strikes me one particular notification, of course, under the VAT Act, which strikes me now, which says that the hotelier were allowed to claim benefit of concessional rate of tax if he were to pay average rate, tax of his earlier 12 months monthly liability of tax, and file monthly returns. Now, one such case where the tribunal held that this is a procedural requirement, payment of tax was important, which was made by the SSE, and his other compliance of not claiming input tax credit, etc. These were the important conditions which he fulfilled, and accordingly, the procedural non-compliant should be ignored, and the notification benefit, which is the heart of giving benefit to the SSE, should be restored, was given in case, if I'm not mistaken, Tulsi Restaurants. So such past instances, past judicial pronouncements can be given as a reference point to the GST authority. Supply to SEZ, would it be subjected to a concession rate of 0.1%? The SEZ authorities are normally using the goods which they purchase for processing it for further exports, processing of goods for further exports. Surely, supply to an SEZ is not supplied to an exporter who sells the goods in the same form. And hence, this concession derivative of 0.1% is not available in case of an SEZ unit. Yes. Rajiv bhai, bolo.
Sir, good evening. I am apology for joining late, sir. Sorry.
No, it's all right.
You carry on. Carry on.
Suddenly your face popped up, so I realized, so I recognized you. All right.
Sorry to disturb you, sir. Sorry.
Not at all. Now, what happens is the merchandiser receives these quantities in lots from various vendors. After receiving at a one particular place, they may pack it, repack it, unpack it, grade it, and put together various sources of his purchases and then make a bulk export. They then load it in a bulk for the exports. Now, what happens is, can you do this exercise? Answer is yes. This notification also categorically provides that yes, in that case, this has to be either delivered at the port where the packing or the stuffing of the cargo for export takes place, or you can deliver to a warehouse which is registered with the customs for the purposes of accumulation of these goods for further exports. So this particular activity is possible. This particular type of transaction is possible. What happens is, from what date should I calculate the 90 days? Now that is a peculiar issue. What happens in this case is, these 90 days will have to be calculated from the first receipt and not the last receipt. And for that reason, the 90 days you will have to be construed very strictly from the first receipt and not the last receipt of the cargo, which is now accumulated from various sources and then exported. For COVID period, we had certain relaxation that have to be seen and have to be considered for the purpose of calculation of these 90 days. Of course, now COVID is over unless we have the another round, and we hope and pray that we do not have another round of wave of COVID. Such COVID relaxation would not be expected in future. Can I make a export? Can I make a supply to an EOU under an LUT? Answer is once again no. You will have to put it on plus tax basis. Once again, smaller issues of these being exempt supply, will the Rule 42 apply? In the correct sense, yes, it would apply, and one will have to apply Rule 42 in that case. Now we'll talk about certain practical issues also here when we're talking about these large cargoes being exported and the documentation. Now, for my export processing of refund, it will be good that this documentation is correctly done. The reference of my shipping date, shipping number should match with my actual bill of exports documents, etc. All these shipping date, etc. is very, very critical for me to make. Unless this matches, they will not be having automatic processing of my refund. So DGFT data will have to be matching with my GST uploading data in my GSTR1. So if that is not matching, my refund automatic refund processing will not happen and will have difficulty. I will have to either amend my data into DGFT side or amend my data on my GSTR1 side by making appropriate amendments, and then only the refund COA those transaction will take place. There could be different challenges like liquid cargoes also. You have challenge in respect of the quantity. Why I say so? When the cargo is moved, you have moved say 9 tons in a tanker. When it is unloaded, the entire tank will not get emptied because of practical reasons, and that time there will be, let us say, lesser cargo. So my initial cargo, which was moved for 9 tons in a particular tanker, will carry the export invoice for 9, but when it is loaded onto the ship, that time it is lesser quantity. So there will be some challenges of those kind will have to be attended to. And when the actual quantity which is recognized and accepted will only have to be put in for the purpose of reporting. Now, when I make a refund application, this is also very practical issue that we am taking it. Should I make the application for refund on a monthly basis? Should I have several months put together? Should I make a yearly application? What should be the approach? Friends, when I apply my rule 89.4 for the purposes of calculation of my maximum refund, I am looking at maximizing that formula. What do I do? When I have a combination of exempt supply as also taxable supply for the purpose of my exports, what happens is my ratio changes on month basis. So what is observed practically is, if I were to process application in a different combination of my months, when I say combination has to be sequential, April, May, June as one combination, or April, May as one combination, April to September as one combination, or it could be August, September as one combination. So when I'm making this a calculation on a different group of months taken together, vis-a-vis making a monthly application or a 6 monthly application or a quarterly application or a yearly application, I could check that out and then try and see which gives me the maximum cash refund. That should be the approach of number of application one should make for refund. So that arithmetics, one should do it when you are reviewing the refund application for the entire year together, and then try and maximize the refund claim. Export of services. Now we were talking about goods for the time. These large players also provide a lot of services. They also avail a lot of services from the foreign or overseas suppliers. So now we'll talk about export and import of services qua these bulk trade players. Now export of services, friends, we have definition 2.6 under the IGST Act, where one will have to see, are we fulfilling the 6 elements which are given in the definition section 2.6 to claim the benefit. So I'll just read out for our benefit here. एक second. Export of services means the supply of any services when the supply of service is located in India, supplier of service is located in India, the recipient of service is located outside India, the place of supply of service is outside India. One will have to see section 13. We will see that also in a while. The payment of such service has been received in convertible foreign exchange, and the supplier of service and the recipient of service are not merely establishment of distinct person, as given in the explanation to section 8. Now, what kind of services are being offered by these large players? What happens is, these large players have in-house facility for doing a lot of market surveys. They do a lot of analytical research in terms of if I were to say agri commodities, they will also see the IMD's weather forecast, the Skynet's weather forecast, other international. They will see what is the acreage of sowing. Let us say we are looking at oil seeds. What is the acreage of the oil seeds which is taking place? What are the other impact of the weather on the thing? Is there any shift of the product from, let us say, tobacco to oil seeds? What is the perception of the market today? What is going to be government policy in place? What is expected in the shift in the policy? What is the advisory issued by the government to the trade in general? What is the economic scenario? All these things, they have qualified people sitting in their research team to do a lot of research. So this research is also given or shared at a consideration to various international players by these players. And basically these players are their own parent companies or the group companies in the other countries. So these are the areas of the service which they export. They at times handle various international cargo transactions on behalf of their foreign parent. So what they do is, whatever is the agreement entered into between the buyer and the seller, let us say Indian importer or Indian exporter and the foreign buyer or foreign seller, they try and help, not negotiate the transaction, not acting as broker, but help them to implement the transaction. Let us say they have said that 10,000 tons of sugar is to be exported. They will ensure that whether the exporter, Indian exporter, has arranged for that trucks or not. If there is a need, he will help the Indian exporter to arrange for the logistics or guide him on behalf of the foreign. If there is some cargo to be booked for shipping, they will help the foreign importer to book the cargo or etc., etc. So all these services, which is not sort of broking. I'm coming to the intermediary service in a while, which is very touchy subject. All these kind of services are being provided by these large players to their foreign counterparts or their other business associates in the other country, because these are large players in the international trade. As you know, we have government policies being moved. Let us say sugar exports being banned, or suddenly there is a holding cargo holding restriction being imposed on storage of, say, wheat or pulses, of course exempted, but still these are the services. Or for that reason, edible oil stock or sugar, or for, say, tobacco. All these cases, there is a shift in the market, government policy based on the market or the what we call food security of government of food security policy of government of India. So all these advisories are given. The issue is, are these real export of services? Once again, when we come to the place of supply, being the place of supply services outside India, I will have to see that I am not coming into the clutches of intermediary services. So what is intermediary service? One will have to see section 223. Now 223 says what is intermediary service. 213, I beg your pardon. Intermediary service means a broker, an agent, or any other person by whatever name called, who arranges or facilitates the supply of goods or services or both, or securities between two or more persons, but does not include a person who supplies such goods or services or both or securities on his own account. Once again, when I say I am an intermediary services, first thing and foremost is I should be facilitating or arranging for supply of goods or services between two entities. So there are three entities involved: foreign buyer or seller, Indian buyer or seller, and me, who is facilitating the transaction of buy and sale of goods or services. If that happens, then I become intermediary. Then I will have to go to the place of supply under section 13(8), which means the place of supply will be the location of service supplier of these services. So if my supply is here, then I will be attracting the GST liability. Now, when I talk about all these export of services, I will have to be very, very vigilant to see that I am not crossing that line of facilitating the buying and selling of goods or services. If I does fall into that category of facilitation, in that case, this will be intermediary services, and I will have to be paying the GST as a forward charge on such services. Now, indenting agency is clear such case of intermediary services. Whether indenting agent economically can bear that burden of the GST thereon is a separate issue for which representation have been made since the service tax era. But the fact remains that here is a case where the services would attract GST. Now let's look at the import of services by these players. Now what happens is, let us say I want to buy certain cargo from other country. I would appoint a surveyor or a local agency to carry out survey of that cargo in the other country. Would it amount to import of service? That is the question. Or at times, I will take the other instance a little later. Let's read. The definition of import. Import of service. What do you mean by import of service? Import of service means the supply of any service where the supply of service is located outside India, supplier is outside India, the recipient of service is located in India, and the place of supply of service is in India. Once again, place of supply of service is in India. Then and then only it will become import of service. Now let's look at this. I will have to go to the place of service to decide whether the place of service is located in India or not. Section 13(3)(a) is very important when we are talking about the services qua the goods or in respect of the goods. I am using the word little liberally in respect of, but let us read the provision in particular. The place of supply of the following services shall be the location where the services are actually performed. Namely, A, services supplied in respect of goods which are required to be made physically available by the recipient of services to the supplier of services. Now I have to make these goods physically available. If I were to survey the goods, I will have to make that goods physically available in the other country for the surveyor to visit, do the survey, do the quality check, and give me report. So if that is the case, the place of supply will be the location where the services are actually performed. In this case, my services are performed in the other country. So that service will not be subjected to the GST liability because it is not an import of service, because my place of service, once again going back to the definition of import of service, is not the place of service not being in India, it is not subject to GST. This is what is the outcome thereof. Now let us say there is another example where there is assistance for selection of lot. I am to purchase the participate in an auction of the cargo which is there in the other country. I appoint a local agency there, local experts there to assist me for selection of lot. There are various lots available. I have to pick up lots. Let us say I'm buying timber in bulk. And there are various lots available. Each lot needs to be picked up. Similar cases for the rough diamond. The site holder who imports rough diamond in bulk also appoints certain agencies to help them to select the lot which they want to import. So such assistance. Now, am I making that lot available for the surveyor, so for the agency there to work on it or to provide his services? Is it the I'm reading the definition again here. I mean, section 13(3)(a) again here. Services supplied in respect of goods which are required to be made physically available by the recipient of service. Am I making it available? Is it my goods which I am making it available? The question is once again of the facts. One will have to go. If I say these are my goods which are made available, I can say that since it requires my goods which are identified by me, which are made available, I can say that the services is performed outside. So I'm covered by section 13(3)(a), and place of supply is the location where the service is performed, and hence the place of supply not being in India, it is not an import of service. So I'm out of it. But can I say that I have made that goods available? I have not even identified. I say that there are 10 lots available. Please help me to select. Once again, little litigative. One can say that I made him possible to enter the premises where he could conduct the inspection and help me select the lot. Who made it possible? Because I made it possible. Can I develop that kind of an argument? Friends, these are all peculiar facts-driven things. So one will have to really go into detail and develop certain types of argument. There would be different types of services which is required. I may be employing an agency to find out the creditability of that exporter, because based on his export, I am planning my production here in India, or I'm committing my bulk supply in India, and I appoint a sort of a agency to help me to ascertain this background. So what we call is background check of the foreign vendor. Is it import of services? In that case, there is no goods which is involved. So this particular provision is not available to me. In that case, possibly this would be an import of service, and not possibly, greatly so, it will be import of service subjected to GST. Ocean freight. Friends, we have discussed a lot about ocean freight, etc. One small point is, one will have to see whether the contract of import of cargo or import of goods is on CIF value or on FOB value. If it is cost, insurance and freight, the value which is negotiated also has an element of freight which is built in to the value of goods which is imported. When it is free on board cargo, FOB cargo, there is no freight which is included in the price which the foreign exporter has charged to me. If that be the case, what would happen is that this particular cargo, I am paying the shipping line for the import of freight. In that case, that is a pure case of import of services of carriage of goods from foreign country to Indian country, Indian shore, Indian port, and for that reason, that is a pure case of payment of RCM thereof. When I'm talking about CIF, we have Supreme Court decision in case of Mohit Minerals, which will come into play, which is surely applicable, purely applicable. Supreme Court, after deliberating on so many issues, have said that, including the power of the center to levy tax on certain transactions, etc., they say that looking to the scheme of taxation, when there is a CIF contract, it is a composite contract, composite supply of goods and services, service being the freight service built into it, and hence there is no GST payment thereof. So this is what is long and short of the RCM on ocean freight. Friends, I'm going little fast because I have already overshot the time by 15 minutes, and I thought I still could share something further. Now, what is the typical issue which is still there? There are certain players. Mohit Minerals case happened in 2022. From 17 to 2022, several players have paid the GST on the ocean freight. Majority of them have claimed the ITC of such RCM paid. So there was no economic loss. there were players who were, let us say, importing pulses or food grains like wheat, or for that matter, say chana, black or yellow peas from Canada, etc. So all these cargo, these are exempt under GST. Obviously, the RCM which is paid for this cargo is part of the reversal of ITC, and for that reason that has become cost to them. Can they file refund of such cargo? Answer is yes, they can definitely file the refund for this cargo. Departmental approach for such refund application is two baskets I can divide. Some states, and in some states, the state authorities have duly processed and allowed the refund, and the center has been disallowing the refund on one or the other accounts technically first, and then to say that since this levy is held as unconstitutional following the larger bench decision, not larger, constitutional bench decision of the Mofathlal Industries, refund claim is not possible. Friends, I had occasion to study this little at a greater detail. What happens is, the Mohit Minerals case, the observation is that the notification issued for levy of RCM is not held as unconstitutional. It is not held as ultra vires. What it is held as, it is not in consonance of the scheme of taxation. It is held as violation of the provisions under the GST Act, and hence the decisions of Mofathlal Industries will not apply. That is what is my reading of this particular decision. Friends, everybody may face this kind of litigation, and one will have to really fight it out. Friends, I think I will have to close because I have already shot off by another 20 minutes. There is something more which can be said, but I think we'll reserve it for some other day. Thank you very much, WRC, for this opportunity. There are some questions, I believe, is there on the question answer box. If time permits and organizers do allow me, I will take them.
Yes, sir. Yes, Rajiv sir. Just you. There are two, three questions. You can address them, and then you can close the session.
Can you share this PPT? WRC will do it. Post this thing.
Yeah.
Can we recording WRT whether supply of services of SC services is exempt under LUT? Whether supply of services? Yes, you can do that. Freight forwarding services, buying and selling space in the cargo vessel will be considered as export of service or intermediary service. And what are the criteria to understand the difference between the two services? Friends, the criteria between the export of service and intermediary is very, very clear. And if you were to read, if I'm not mistaken, circular number 229 is this, that in an intermediary, there will be three parties, and the supplier or the recipient of either goods or services sitting out in the foreign country is one party, buyer or seller of goods or services in India, and the intermediary or the broker facilitates the transaction. When you say facilitates or arranges, what it means is he is there as a middleman to bring together the transaction, to fructify the transaction of sale or purchase of goods or services. So there has to be three parties in all cases of intermediary. Now the fine line is, if I say there were two transactions in intermediate case, there will be three parties and two transactions. One transaction is the export of goods or services from the foreign supplier or this thing to the Indian supplier and the supply of services by the foreign by the intermediary here in India to the exporter. Now that is how it is termed as an intermediate. This is the fine distinction. I think circular, if you were to read, that should help you out. And there are n number of decisions which can also help us on this. Nowadays, central offices are giving exports RCM notice on bank charges deducted by buyer bank as treating it as a import services. How to counter the same in appeal? Well, this is a question for the session on refund, but whatever short answer I can give, I will give now. When I say what is my export realization? Export realization, let us take an example. My export realization was of say $1 lakh, out of which $2,000 is cut by the foreign bank and remitted me 98,000, 2,000 being his bank charges. Well, one will have to understand, if my export realization is 1 lakh, it is realized in 1 lakh. I have paid this 2,000 in foreign exchange to the buyer there. RBI old circular says that if I have paid the foreign exchange there to a foreign service provider there in the other country, then still it will be treated as export realized by me. That circular can be taken help of. I do not recall the reference of the or citation of that. I believe I have answered all questions. Thank you very much.
Thank you very much, sir. So, just a formal word of thanks. The sir has provided us immense knowledge today on the topic of in this series, and I would like to thank you on whole behalf of WIRC office bearers, and I would like to request all the attendees to have a big round of applause at your places for the sir for his valuable contribution to the session. Thank you very much, sir. Thank you very much once again.
Thank you.
Now I would like to hand over to CA Pooja Jain for our next speaker, CA Rajiv Luthia sir, who is present in the webinar. And I welcome our WIRC chairman Arpit Kabra sir in the session. So now I would like to request Pooja Jain for the formal introduction of our next faculty, CA Rajiv Luthia sir. Over to you, Pooja ma'am.
Before Pooja would take it, it's a pleasure, sir. Rajat sir, really thank you. I think what a deliberation. Such a passionate deliberation, sir. I think, really wonderful. I think most of them have asked for the PPT, but believe me, this session has really been, well received, and I think would go in a long way. The Relearn series that we launched, in real sense, this is what is the Relearn. So I think thank you very much for creating this space, sir. Thank you. And really, we want to come now. We want to see all of you in action again in physical format. I think this would inspire a lot of people that such kind of sessions will now be available in physical form. And I have to again and again press upon this fact that, since CP criteria has now changed for a calendar year, now 20 CP hours are compulsory and they will all be in physical form. Only 4 can be taken in virtual. So I think we would soon see each one of you at any of the places that we are in. And at BKC, we are all waiting to welcome all of you. Next speaker, I think Rajiv Luthia sir, he's been a mentor to all of us, someone who has really always been available. So thank you, sir, for accepting our invitation. And
thank you for giving opportunity.
I really look forward to your sessions, sir. Your sessions are always really very, very thoughtful and insightful. So I think a wonderful combination that we have today in both of you. Thank you, sir.
Thank you for kind words. Thank you.
Yeah, before Rajiv Bhai takes up, my gratitude to the institute, and once again to the chairman for having said these good words about me. Thank you very much for this opportunity. Rajiv Bhai, please allow me to leave the session in some time.
No, sir. This is not meant for you, sir. I'll be speaking much below your knowledge, sir.
Not at all. Rajiv Bhai, it is always pleasure to listen. And we always learn interacting with each other. Thank you.
Thank you, sir. No issue about it.
Thank you.
Thank you, everyone. Thank you, everyone. Now I would like to request Pooja ma'am for formal introduction of Rajiv sir. Over to you, ma'am.
First of all, thank you so much, sir, for the discussions, and Arpit sir for arranging this session. I would introduce Rajiv sir. Rajiv Luthia sir is a CA LLB, and he also holds DSAT degree, and he's practicing since 1987, and and his firm name is RJ Luthia and Associates. And he, as we all know, he's a service tax and GST specialist. He has contributed at various forums. He gives us lectures on whether it is WRC of ICAI or BCA or CTC. He's always available and always guides us on various topics. And presently, also, he's an advisor for Indirect Tax Committee of Chamber of Tax Consultants. And he also contributes to monthly journal or newsletters which are issued by WRC of ICAI, as well the CTC updates. So I'll not take much of your time. I would just request Rajiv sir to take up the session. Our today's session is on retail and FMCG sector. Sir, over to you. Thank you so much, sir.
Thank you, Pooja, for your kind words of introduction. At the outset, my sincere thanks to the WRC and especially the chairman Arpit Kabra sir for having considered me fit for being part of the faculty for this a wonderful program that is GST Relearn Refresher Series virtual mode. Sir, we eagerly look forward for a physical mode. I second your thought process, and I'm sure it will happen soon under your leadership. First of all, compliments to your entire team for structuring a very good program, and thanks you for considering me as part of it. It's always pleasure to address the WRC participant. Let me tell you honestly, it's you sit on the other side of the table. It's always a learning experience when you talk to your own members. Okay, and find the industry-wise series on the GST, because this is a consumption tax and it has implication on the goods as well as service based on their nature and characteristics. I'm sure this program will be useful to all the participants. In the time allotted to me, I think we are running short of time. The coordinator can tell me where to stop, because I think I've started some 15-20 minutes late. I have about 45 plus slides, and I have discussed with Gautam Lath sir, who has been talking to me, WRC Regional Council member. And he has informed me that let us take it issue based so that member will find it more interesting. With this, I'll start my presentation. Please allow me to share. I'll share my presentation, and thereafter I'll forward it to WRC for the circulation. Whatever you want to do, you can go. Thank you, Arpit Sarji, and I'll now share my presentation. Thank you.
Thank you very much, sir.
Thank you. Help me to share this. Share it.
President
Give me 1 or 2 minutes, sir.
No problem, sir.
No worries, sir. No worries. You can take your time.
He's on desktop.
wait a second. Your presentation is not open.
Desktop. Open desktop पे चलो.
Open.
Yeah.
अभी आपका मीटिंग को बड़ा करो.
Perfect, sir.
Yeah. You can view, no?
So put it in the slideshow mode. We can see it now.
Yeah.
Yes, sir. It's visible.
It's visible. Yeah. I think it's visible as well as audible, correct?
Yeah.
Yes, sir. Very much.
Yeah. Thank you. So let us start with this. So topic for me today is GST on retail and FMCG products. I have about 45 to 47 slides, about 10 issues, and some background about this FMCG and retail sector, and we will take up. Friends, the topic is very vast, and within the time allotted, we have to cover a long way. So I'll straight come to the points. Two things before I start. One is, if you have any issues, if you can put it in chat box, that will be ideal, so that it will not disturb the flow of the participants. But if the organizer feel, and if you want to ask a question across, I leave it to the organizers. Let them ask as per this thing, but consider decorum of the time, so that stick to the topic per se to that extent. With this, let me start the proceedings. So today I'm going to take you through on the topic, the background about the FMCG and the retail. The more important is the classification of goods. It's a very vast topic, so I have decided to take you through one or two important decisions which will give flavor about the classification, how important in the indirect tax, especially in the goods part is concerned. Then there are issues related to GST in the various transactions faced by the retail and the FMCG, that is free samples, goods returns after expiry date, buy one get one free offer kind of schemes, buy more save more schemes, the discounts being offered by the dealers, the GST charge sometime on the exempted products and its implication. Then sometimes the goods are being sold outdated for loss. How about the ITC thereof? And the ITC on the expenditure incurred for the various distribution and sales scheme and the redemptions of voucher. Friend, these are the few areas which I will cover today during my presentation on the FMCG and the retail part is concerned. Much ground is left out to be covered, but then we'll see if you have any other issues, we'll deal with this. So to start with, first is FMCG and the retail is concerned. It is the fourth largest sector in the Indian economy. So you can understand the importance thereof. And basically, we can classify the FMCG into following three areas. That is, one is the personal hygiene, food and beverages, and a general healthcare products are concerned. Now, as the world is shrinking with the help because of the communications and the transportation and logistics, more and more awareness is created amongst the citizens and civilians. And accordingly, it is very easy to access every kind of goods and services for a person located anywhere in the world. And that's how the lifestyle has been changed. And that is the main reason of the mammoth growth in the FMCG and the retail sector is concerned. And it is now become consumers market all over the world. In the FMCG, especially when you talk about the goods, the classification is the most complex part of it, and which will play very pivotal role. So you need to classify your goods and services properly. Of course, the goods is most complex out of it between these two. And why it is important from the perspective of GST is concerned, because for determining the rate, claiming the exemptions, and thereafter whether the goods or services which you are dealing in is covered within RCM, that is reverse charge mechanism. That all you will come to know only and only if you classify your goods and services correctly as per the GST law. If you fail to do it, then the consequences will be very harsh. That one is you need to pay huge demand of tax, interest and penalties. Sometimes you have made the payment of tax even without collection thereof by treating that as exempted, which will become out-of-pocket theory. And the last is there could be a loss of reputation when incorrect tax have been charged on your brand or your product is concerned. These are the few key implications are concerned. There are many others also. That's how classification of the goods for FMCG is very, very important, especially for goods part is concerned. There are a couple of important things. There is a notification number 1 of 2017, dated 28th of June 2017, which gives the rate of GST applicable on various goods. It contains a huge notification. This is, and the other notification is number 2 of same 28th June, which provide list of various exemptions which are available specifically for the goods concerned. The next part is concerned. The classification is goods are concerned. It is based on the customs tariff. That is what we have adopted for the purpose of classification in India. And for which are the factors which are considered as very important for the purpose of classification of goods are the ingredient thereof, the manufacturing process which has been carried out, the packing thereof, end use thereof, and the last part of that is concerned the trade parlance, the common parlance in which the goods have been understood by the customer. These are the few important parameters for the purpose of classification. You will feel why I'm dealing this, because classification matters are concerned in the old excise regime. It has reached to the high courts and the Supreme Courts on a frequent occasion. In my presentation, I'll take you through only 1 or 2 such important case laws, which will give you flavor on importance of the classification. And for that, thereafter, I have not taken any case studies because it is a endless, that is, the subject is very vast thereon. First important decision is about the global tele mall is concerned. It is a Madhya Pradesh High Court. This is vis-a-vis excise. The principles by and large will remain same. That's why I thought of collecting selecting this particular decision. Here, in brief, the facts of the case are concerned. It is appellant was Mrs. Global, and they were engaged in selling the goods called the Kashyap oil and the Kashyap herbal powder hair wash shampoo. Basically, when the name indicates, I am sure all of you have a flavor. What is their grade in this classification? It is oil and the shampoo and the wash shampoo and the hair wash. So basically, simply one can say it is a cosmetic only. Now let us see what is the fact. Whether their goods are, the issue involved here is whether these goods will classified under chapter 30 or 33. Important is chapter 30 stands for Ayurvedic medicine and 33 stands for cosmetic and toilet preparations. I will say it's a great contrast between these two products. Now the matter has reached up to High Court level for the classification of these products is concerned between 30 and 33. Look at the arguments. As far as the appellant is concerned, appellant has argued that when the product manufacturers are from the ingredients specified in the Ayurvedic text, okay, the same should be classified as a Ayurvedic medicine only. That is a major argument. Of course, it is a decision is a very vast, big, but I'm taking the important few points out of the decision. This was a major argument. So appellant was telling that these products, although they are shampoo or the powder hair wash, or it is a oil, but still it is a more of a Ayurvedic medicines. On the other hand, the department who says that no, the product in question are to be considered as a cosmetic and toilet preparation only, even if there is a presence of therapeutic quality in the product, but it will not be excluded from chapter 33. Why this issue is because the rate of excise duty on Ayurvedic medicine was much lower as against the one which is applicable on the cosmetic. And that's how this issue crop up between these two. I hope you understood the issues, what I'm trying to say. Now, what court has opted ultimately? The court has discussed in length, but while discussing and pronouncing this decision, the courts have referred the various decisions. Now, one of which is in the case of BPL Pharmaceutical, that was versus CC Baroda, again excise. But there the issue was that about the classification of Celsum. That was an anti-dandruff preparation containing. Now, anti-dandruff, you know, by and large, it will go as a cosmetic. Okay. And which was containing 2.5% of the selenium sulfide, a chemical which was more of a medical nature, having regards to preparation, that is a label, literature, opinion, or commercial parlance undertaking. The Honorable Supreme Court held that the item will fall under drugs and not cosmetics. See, the Supreme Court in this case has held that even if it is a dandruff is by and large, we can understand anti-dandruff preparation, it will go under cosmetic, but that is not the case. Supreme Court say, no, it will be a drugs. Obviously, the rate classification, the rate will also change. Similarly, other case was that of a Sharma Chemical Works, and where there was a dispute was there about the oil. And you know, thanda, thanda, cool, cool. That is the advertisement we get in the newspaper, Bunful oil. Now here the Supreme Court said that mere fact that the product is sold across the counter, generally what is a common parlance understanding is whenever you go for buying a medicine, you go to the medical store and you have to give a prescription which is normally prescribed by the doctors. As against that, the cosmetic, there is no requirement of doctor. You can go and buy at any store and you don't require any license to sell that. Okay. And you can buy it without prescription also. Now here the Supreme, in the case of Sharma Chemical Works, the Honorable Apex Court has held that mere fact that the product is sold across the counter and not under the doctor's prescription, that does not by itself lead to the conclusion that it is not a medicament. That means even if it is sold at a general store without a prescription, still it can be a medicament. That is what Honorable Supreme Court stated. And the burden of proving that the item which is understood by the customer in a particular manner is always on the revenue who has alleged. And relying on the aforesaid decision, the Honorable Tribunal held that the appellant authority has rightly classified the product as a medical preparation. So Bunful oil, thanda thanda cool cool, is also a medicine and not the cosmetic. So that is, you can understand how the classification is important and how it has reached to the conclusion. I'm sure my understanding also was, if you ask me apparently without referring to this decision, I will always say Bunful oil is nothing but it is a cosmetics. It cannot be a medicine. But look at the observation of the court. We'll go further in this. Now here further in this case is as laid down by the by the Apex Court in the case of Amruta Anjan versus the Commissioner as far as Supreme Court. The only requirement here it has been observed was, only requirement is that the product contain Ayurvedic ingredient. It is not essential. So once the product is containing Ayurvedic ingredients, there is not a requirement that the manufacturing process which the product undergoes should have be there, follow the formula which is prescribed in the book. It was held by the Supreme Court that Amrutanjan is a Ayurvedic medicine and it is to be classified as such only. Okay, it gives a relief to the pain, etc. Amrutanjan balm. So after considering these kind of various decisions, it was held that shampoos or the hair wash which is prepared from Ayurvedic ingredients and having the therapeutic quality was classified as Ayurvedic medicine. This was a decision of a Madhya Pradesh High Court in the case of a global tele mall, where the issue was between the cosmetics or the Ayurvedic medicine. This is about the classification of goods. One more decision will come on this. Hello. Yeah. So the next decision thereafter is in the case of Times Pharma. This is the last decision and then we'll go for the other cases. But the classification, how pivotal and important, that is what my idea was, to draw all the participants through the classification of goods are concerned. And I am sure in the years to come, we will have a lot of disputes or litigation on the GST fronts will be there on the classification of goods. ITC and these two will be the most complex part. Now here in this case, Times Pharma was a matter Supreme Court. The fact of the case was there whether the MoistureX cream falls under chapter 30. 30 chapter is for a medicine, medicament, and or under chapter 33, which is of the beauty product, that is cosmetics or makeup man, for which is meant for the care of the skin or cure of the skin. That was the issue. So the MoistureX creams are concerned, though there are so many MoistureX creams are there. What is the classification and what is the rate of tax? The matter has traveled to Supreme Court. Now here the argument was, this case was in Supreme Court, department has filed this petition. So argument as an appellant was that by department. The counsel argued here that MoistureX is mainly used for what? It is used for the care of the skin. Now care, there can be, care means preventive care. It prevents you from the damage. That's why the word is used, care of the skin. So then there is no question of cure. That is the differentiation. So thus they are to be classified as a cosmetic only and under heading number 3304. Now here it has been further stated that even if such cosmetic product contains certain kind of subsidiary pharmaceutical content, even if they have certain curative or the prophylactic value, still they are treated as a cosmetic only. This is the argument of the department. It is contended that the product is sold across the counter and not necessarily at a medical store. It is being sold at a general store also without prescription. Hence, it is not medicament. I hope you understood. This is the argument by the department in Supreme Court for classifying this MoistureX cream as a cosmetic. As against that, what the assessee argued, that is respondent, Times Pharma. They stated that the very presence of the pharmaceutical substance will change the identity of the product. Since the constituents are used not for the purpose of care, but it is for the cure, that's why it will be medicine. It is a curing the disease. That is the content of that MoistureX. That was the argument. He says that while producing, we are using a lot of pharmaceutical substances, which is meant for the curing of the disease. That is one. Secondly, in the product literature under which it is being sold out, the cream is indicated for the purpose of utility, that of dryness of the skin associated with the winter, then the fissure feet, crack the nipples, in the treatment of pathological dry skin conditions, and also for the dryness associated with the leprosy and the clofazimine. So they said our literature, so while selling also the company says that what is the utility of this cream. Now based on that, it should be a case for the medicament. That is what the appellant is. Ultimately, court has observed that the contention that MoistureX is a moisturizing cream used for softening of the skin cannot be appreciated. He said softening is not an important or the predominant purpose for which this cream is meant for. The use of cream is not for the purpose of care, but it is primarily for the purpose of cure. And that is why for the cure of the disease, which is there or in the year to come for related to skin, on for the result of the sun or tan or dryness, etc., etc. So the court also, Supreme Court also felt that it is not for the purpose of care, but for the purpose of cure. That is what the decision in the case of Times Pharma. While referring this decision, the Honorable Supreme Court has stated, also discussed about the few decisions. One was of Meghdut Gramadyog Seva Sanstha. That was also Supreme Court decision of 2004, wherein it was held that the composition and the curative properties would make the difference in the classification. Composition and curative property of the product. So if the product is composed of pharmaceutical constituent which have curative properties, the product is to be classified as medicament only. This is very, very important decision. And that is how it has been stated. The Banful oil is concerned is a Ayurvedic oil and it is more of a medicament. I'll not read the other part. This you can refer it. I will circulate to the participants this part. So with this Times Pharma decision, the Moisturex was held as not as a cosmetic but as a medicine, and the rate of tax classification will under chapter 30 and not 33. Friends, these were the two important decisions I thought will be an eye-opener for you to understand how important is the classification of goods are concerned, even in the old regime in GST, in excise, and now under the GST. Of course, there can be many case studies we can take, but I have not selected any on the goods, but now we'll come on the other issues which the FMCG and the retail segment is facing. So first issue is regarding ITC related to free samples. Here is a company called Unilever, and they are manufacturing Pantene shampoo. Now, this is a new shampoo they have produced and they want to launch in the market, promote the product in the market. That's why they run a promotion drive. What they have done is they have contacted a newspaper, and with every newspaper, they stapled one of the shampoo pouch, okay, which goes as free of charge with the newspaper. So it is nothing but a promotional activity which is being carried out by the Unilever company. I hope the transaction is clear with the participants here. The question here is, can Unilever is eligible to take ITC of the various input and the input services which were used in the production of this promotional sachet? Because this sachet is concerned was not meant for sale. It was only for the distribution and the promotion, etc. So there was no consideration being charged. So the question is concerned whether GST is applicable on this. Obviously no, because there is no consideration and there was no supply also because there is no buyer on this side. Supply happens only when there is a buyer. This was distribution as a free of charge, maybe as a sample distribution, you can say. Now, whether ITC, so there is no supply, there is no tax liability on the supply side on this. When there is no tax liability, immediate question will come whether these free samples are concerned, the consumption of input and input service for the purpose of this free sample, whether you will be eligible for ITC. For that, let us debate, discuss, and what are my views on this. Even there are CBIC circulars in support of that. So first is concerned, what is the idea of free samples is concerned. As far as free samples, either you have given this free sample to your related party or to the other than related party. Why this is very important is because there are certain transactions which are listed in a schedule number 1 of section 7 that is related to supply. The transaction will be treated as a supply even if there is no consideration. So free samples, there is no consideration. It will become taxable supply only when it is being given to related party or a distinct person. Now, in this case, we assume this has gone in the newspaper and it has been given to all the customers who are buying the newspaper. It will not be possible also to find out whether it has been gone to the relative or no. So if that means it is not gone to related party. But suppose it has gone to related party in other cases, then on the supply side, GST will be payable. And how to find out the value? Section 15 will not help you because nothing has been charged. And that's why 15.5 you will have to go, and which says that as per rule 29, you have to determine the value of the supply and you pay tax. On the other end, when these free samples have gone to person other than related party, which is a case of our this thing issue, it is not taxable because there is no consideration. In that case, the section says that there is a reversal of ITC will be required as per section 17 subclause 5H. That section 17 subclause 5H, it starts with notwithstanding anything stated in section 16.1 and 18.1. The ITC will not be eligible on certain supply, on certain transactions. And in that 17.5H is one of the transactions which says that goods which are lost, stolen, destroyed, written off, or disposed of by way of gift or free samples. In our example, it is a free sample. So wherever there is a free sample is there, corresponding ITC, you are not eligible only. That is why it has gone to block credit 17.5 and you have to reverse. So in our example, the Unilever will not be eligible for the corresponding ITC. I hope the things are clear on that. The circular is in support of that was issued by CBIC, and that was on 7th of March 2019. The number I have already given, and whatever I have stated you, it is also relying, the circular also clarifies, it is also on the same line. So I'll not read whatever has been stated, I have spelled out just now, but circular is also supporting our views to that extent. The next issue is about the ITC and taxability of goods which are returned after expiry date. In pharma industry, this is very common feature. After expiry days, if the medicine remain unsold, it is returned back. Same way it is in the case of a food. There's eatable industries, etc., confectionery, Cadbury, biscuits, etc. also. After expiry date, the goods are concerned is not fit for the human consumption, and they are not banned. They are not allowed to be sold out. Here's an issue related to ITC. Example, there is a company called Parle who have supplied the biscuits to its distributor named Indian Initial Logo Distributors. They have supplied biscuits worth rupees 5 lakhs in July 20, and the distributor has returned the expired biscuit after the expiry date worth rupees 2 lakh out of this lot in the month of November 21. So it's almost about a year and a half been passed between the transaction of supply and return. Now here various issues comes in. The first is the issues which we want to debate is whether initial logo distributor, that is a dealer, will require to charge GST on the biscuit which is returned to Parle. In fact, actually they are buying from Parle. But in this case, the goods were outdated. That means it is after expiry date, they return it back. That return it back will be treated as a sale or supply or no? That's the first question. If that being a sale or supply, then GST is chargeable or no? That is the first issue. If yes, and if GST is charged, whether Parle will be entitled for the ITC? That is the next question. The next question is, can Parle issue credit note to the initial logo distributor, that is dealer, for the when the goods are being returned back? Okay. And can the GST be reversed by Parle once the credit note is given? That means you are reducing the sale price. Correspondingly, you are bringing back your goods. So whether that reversal of ITC is possible in the hands of Parle is the second question. The next is what is GST implication if Parle destroyed the expired goods? I'm sure there are so many issues involved in this, but I hope you could able to connect what I'm trying to ask between these. The Parle wants to know the tax implication, ITC implication, and initial also wants to know about it in the entire transaction. One very important point which I would like to draw here is concerned. You know that for the purpose of returns, goods returns are concerned, if you want to reduce the tax liability, then that returns of goods should happen within the time prescribed, and section as per 34. The time limit of issue of debit credit note is concerned has to be maintained. Now it has turned out to be November 20. Earlier it used to be, earlier it was 20 October. Now it is 30th of November from the end of the financial year. Specifically in our example, I have selected the date beyond that. So when it was goods which were sold in July 20, even if he wants to return and issue the credit note for the reversal of this, the deadline that point of time was 20 October 2021. In our case, it has happened in November 21. And that is the reason for selection of these dates. Now let us see the views on this. First is the goods have been expired, the expiry dates have happened, so goods have been returned by the distributor. Now there are two options available to the distributor for this transaction. The first option is concerned, it can be treated as a fresh supply of goods by the distributor to the manufacturer. So thereby the Parle, who is otherwise was selling the biscuits, now will step into the shoes that he's buying the biscuit. The distributor is selling the biscuits. It will wholesaler returning the goods tantamount to the supply of goods are concerned. Forget about the financial presentation in your financial statement. There you may say purchase return. But for the purpose of GST, it will be treated as supply. If you want to do this, then in that case, you'll have to charge GST. So initial will have to charge GST on parlay. Once it has been charged, parlay will be entitled to take ITC because it is a purchase of good which is in the course or furtherance of business. The only issue will come is that since it is post expiry they have purchased, they will have to destroy these goods. Once they have destroyed these goods, they are not sold further. And immediately you will come in the court in section 17(5)(h), the clause which I have read, which says that ITC will not be available when the goods are lost, stolen, or destroyed. In this case, you have lost the goods. You have lost the good now, but you have destroyed the good. Sorry. So the ITC parlay will have to return, reverse it back to that extent. This is the first method in which they can resolve this. The second option available in this case is that issue a credit note. Credit note has to be issued by parlay. Of course, the distributor can also issue the debit note corresponding to that. And then when the credit note is issued to that extent, the manufacturer shall issue the credit note along with the GST if goods are returned within the specified time. That is the timeline which I was talking about. In our example, July 20, when you have sold, the timeline to issue this credit note for getting the GST credit was 20 October 2021. Before the filing of the, if that is, it has to go in the return should have been filed before that, and the credit note should have been issued in the month of September. So the credit note period should be dated 30th of September or prior to that, for which return should have been filed by 20th of the October. Then you can give this, which I'm sure the date was missed because the transaction happened in November 21. If the time limit of 34 has lapsed, which is the case, then you can issue financial credit note. That means the tax which parlay has charged and paid cannot be reversed in this case. So if goods destroyed in such case, because since you have never reversed the credit, the ITC attributable to the manufacturer of said good shall be reversed if the credit note is given within the time, and then ultimately the government got a less tax because you reduce the value by issuing the credit note in time. The government's tax collection goes down. Immediately corresponding ITC will have to be reduced and it has to be made good. So either of these method you can follow while doing it in this case, and you can resolve these issues. With this, we'll go to the next this thing, that is buy one get one free scheme related issues. Now in this case, let us take the issue. Often we find these kind of announcements or the advertisements, lifestyle, that is real deal, buy two, get one free. Here, and there is another comparison between this, another shopper stop. There also they give advertisement, buy two and get one free. Both are by and large, for the common man it is same. Now look at the scheme, how it comes. As far as the lifestyle is concerned, the scheme says that if Mr. A avails this offer and buy two shirts, they are of 1,000 each, one on which he gets one shirt free. Buy two, get one free. And same thing will happen at shopper stop also in this scheme. Now, how lifestyle bills it? Lifestyle will bill in this way. They will write down 3 shirts and the value is 2,000. That means otherwise 2 shirts is costing 2,000, but when one is given free, there is the invoice 3 shirts sold for 2,000 rupees. On the other end, shopper stop is issuing bill saying that 2 shirts sold for 2,000 and for 1 shirt given free under the scheme, and that's how nil value, and total is 2,000. For customer, there is no difference whatsoever. Okay, in both the case, 2,000 is the value and thereafter GST is being charged. Now, what is our issue? We want to know, will lifestyle and shopper stop require to reverse the ITC of GST paid on the shirt given as free? Now, there are 2 possibilities. Either these shirts are purchased by both the companies on that they have paid tax, or they have manufactured this shirt in-house. In both the case, there will be ITC on the inputs, whether they have to reverse because it is given free. That free word is concerned where department officer will always poke in their nose and they will try to insist that since you have not charged anything, you have not paid tax to the government to that extent, so you should reverse the ITC. That's why this question, lifestyle and shopper stop. The second is, there is another question here is, whether if lifestyle decides to give one belt, we also free of charge on purchase of 2 shirts, because here the product is also different, whether there will be reversal or no. So let us take our views one by one on this. Again, this 17(5)(h), which is very, very important, and which says no ITC in the case when the goods are lost, stolen, destroyed, written off. Mark the words. good lost, stolen, destroyed, written off. Nothing has happened in this case. Or disposed of by way of a gift or free samples. Now you have to give a thought whether it is given as a gift or it is given as a free samples. If it is given in either of these two, then only reversal comes. In our example, what is happening? 2 shirts ke upar 1 shirt we are giving free. Okay. Can you say it's a sample? I am sure it is not a sample, because for whenever somebody distributes the sample, there is no guarantee that he will buy. Okay, he just give free of charge as it is. Okay, like shampoo example we have given. In the first example, Unilever is concerned, Pantene shampoo was given as a sample. And secondly, gift is concerned, in natural corollary of the gift, it is a given out of natural love and affection. So there is never been a consideration for the gift. It has been given, there is no quid pro quo. That means in return, you don't get anything when you give a gift. Now, these are, so that means the intention of the law is concerned not to allow the ITC only in certain transaction, that is the transaction of gift or transaction of free samples is concerned. In our example, there was an offer is buy one, get one free. That means it is a conditional sale. The free shirt is not given to everybody. It is been given only to that person who has purchased the 2. You can't say, मेरे को 2 नहीं लेना है, मेरा वो फुकट वाला एक दे दो मेरे को. ऐसे कोई नहीं होगा. Fine. So even you go to the restaurant and chutney is unlimited, doesn't mean घर में चटनी लेके चले आओ, इडली खाना ही पड़ेगा. So same way it is a conditional sale. So conditional sale is not comparable with gift and free sample. So it cannot be considered as a free sample, neither there is a gift. If that being the case, it is a sale of 2 products for price of 1. We can say that 3 shirts were sold for a price of 2, or as the case may be, but it is certainly not a free sample or gift. That's why, in my view, it will not fit into 17(5)(h), and both the company is not required to reverse the ITC. Friends, I have taken most of the examples are the real life examples which either I have faced or come across for opinion, etc. And these are the issues which department is raising during the course of the audits. I'm sure you must have faced GST audits, and these type of schemes, whenever your client is running out, these issue will definitely crop in, and the audit party will always ask you explanation, asking you to pay the tax on supply front or reverse the ITC. In my view here, ITC reversal is not required in both the case. And even if in this case, one step ahead, if belt is given free of charge to the person who complies with the condition of buying 2 shirts, then also there is no need to reverse the ITC of the belt, because everything is a conditional sale. Belt is also not given as a gift or free samples. I hope the things are clear to that extent about these issues. With this, we conclude to this third issue. We'll go to the issue number 4. We are at 7:40 right now, and I have 6 to 7 more issues to cover. So I thought, let me complete all those issues first, and thereafter, whatever comes from the participant, I'll take if time permits. The next is buy more, save more. That is a first issue. Take an example. There is a company called Zeal, which is very, very famous company for the monsoon collections. You get wind cheaters, etc. of a Zeal. Now they have come out with a scheme for the distributor. They say that for every purchase of raincoat, they will give you a lucky coupon code. And that code is concerned, you have to keep it with you. At the end of this, that is during the purchase of this monsoon wear during the monsoon season. At the end of the season, they will come out with the lucky draw, and whosoever's name appears in the lucky draw, they will award him 2 prizes. One is a first draw, there is Alto car, and second draw, it's a gold coin. That is only given to a winner of the lucky draw is concerned. Now, Zeal want to know 2 things: whether they can avail the ITC of said Alto car or gold coin, which they have purchased for the purpose of distributing to the winner of this lucky draw. That is what the precise issue is concerned. Okay. Now let us take a view on this. First of all, what is the criteria for ITC? Section 16 subclause 1 is very important. I will not read it verbatim, but what it says that the registered person is entitled for the ITC of the goods and services which are used or intended to be used in the course or furtherance of business. That is the only requirement. Now, with that being the case, Zeal is concerned using this Alto car or the gold coin solely for the purpose of furtherance of business, because Why this they are giving? To increase the sale, boost the sale, promote the sale. Now, so that's how it is, a sale promotion activity, one can say, being carried out, which is part and parcel of business. Now, that means 16.1, there is no bar. The next question is whether this is a block credit. For that, you have to go to section 17. For again, that 5H will come into play. The wording is good, lost, stolen, destroyed, written off, or disposed of by way of gift or free samples. We have enough debate on gift and free sample. In considering that debate, whether this scheme may, after the lottery, if somebody wins after the lucky draw, whether can you call it as a gift or free samples? In my view, it is not at all a gift, because gifts are concerned, it is always given out of natural love and affection without any condition. Here in our example, there is a condition that you have to buy a anywhere, then only they will give you that code number. Thereafter, they will have a lucky draw. And if you are a winner, then only you will be entitled for the gold coin or the car, as the case may be. If that being the case, there is no question of gift. It is not comparable with the gift. And therefore, they are not fitting into the section 17.5H. Now, coming to free samples, I am sure it is not a sample at all. Because when you give sample, it is the product which you are dealing in. You want to product. I am neither dealing in gold nor in the car. This is only an incentive which I am giving, sale promotion. So, and the lastly, more important, in the samples and give both the case, there is no quid pro quo. In our case, there is a quid pro quo. That means there is a consideration. What is the consideration? It is only those customers who is buying the rainwear will be eligible for lucky draw. And so that means first you buy something, that means there is a supply and relation, quid pro quo has happened. Thereafter, you get a lucky draw code number, then lucky draw happens, and then you will be entitled for this car, or as the case may be, a gold coin. So in this case, it will not be covered under a 17.5H, this transaction. There is no bar, there is no block credit. And in my view, you are entitled for the ITC. So Zeal will be entitled for the ITC. The question many a time it will come is concerned. This will be supply of car or supply of gold coin. Yes, obviously it is supply of car and gold coin. Now, whether it will be without consideration, yes, it is without consideration, because there is no consideration separately been paid for this purpose. And suppose that has been given to related party. Somehow during the lucky draw, some related party get it, whether it will be treated as a supply. So whether you are covered by section 7 schedule 1 entry, you have to be very careful on that part of it. And if that being, it will become taxable supply. Without consideration also, it will come into play, and you have to go by section 15.5 and the evaluation rule for discharging. Only thing, it will become supply only and only if it has been given to a related party or a distinct person. Otherwise, it will not be there. But there is no need to reverse the ITC in either case. The next question is about the discounts. Discounts or the various offers been given. There are various kinds of discount, friends. So let us take one example, that is Balaji Wafer is one of the company where they have come out with these schemes giving a lot of discounts. One is to the distributor, they stated that if they purchase wafers packet worth rupees 10 lakh in a year, then they will give them volume discount 5% on the entire purchase. That is qua financial year. Second scheme, they announced that the credit period for making payment of purchase they have granted to the distributor is for 2 months. But they say that if you make payment within 1 week of time, then we will give additional 4% cash discount. That is also announced before the supply. And the third is concerned, in the vacation period, May 23 vacation period is concerned, they select that whosoever purchases goods or wafers more than rupees 2 lakh for only in the month of May, then we will give you another 2% discounts on this. So these are the various schemes which Balaji Wafer is running. The issue comes up is company is of the view that in all the transaction, what I am giving is, in the first case, there is a volume discount. Second case, there is a cash discount. Third theme is concerned, there is a scheme discount. All these discounts are concerned is been upfront announced by me. And therefore, it will be reduction in the price, reduction in the taxable value. And the tax is to be paid only on the net consideration. But the auditor of the company is not well versed with the GST law. He is of the view that all these discounts are nothing but a consideration which you have paid to your dealer for promoting and marketing your goods, because you want to say make more and more sale, and that will happen through your promoter, and therefore you to encourage that you have come out with this scheme. So to that extent of discount, it is a consideration which is being paid by you to the distributor for the marketing of your product, which is nothing but a service, and therefore the distributor will have to charge 18% GST on the incentive, and you need to charge GST on the full amount. Now, Balaji got confused, and that's why they seeks your view. Let us take the relevant provisions. Section 15 is a valuation sections of the CGST. What it provides, subclause 3, it provides that the value of supply shall not include. That means this is to be excluded. Now, what is to be excluded is a discount, and that discount which is given before or at the time of supply. So by and large, this is called a volume, quantity, or trade discount, which are always been given before or at the time of supply, across the counter or before the supply. That is one part. Then second is also say and after the supply. Sometimes the discounts which are given after the supply are also to be excluded from the valuation, subject to condition that such discount is in view of an agreement which was entered into at the time of supply or before supply, and it is linked to the transaction of the relevant invoices, and the ITC thereof is concerned is reversed to the extent of the discount by the recipient. So that means, in nutshell, the value of supply should not include certain value of discount subject to you fulfill the conditions. In our case, if you look into it, the volume discount is announced much in advance. They have stated that whole year volume, if you cross this amount, we'll give you discount at the end of the year. So the contract was known from day one, and it can be linked with the agreement which is documented. So at the end of the year, this debit credit note transaction will happen, and certainly to that extent, Balaji can reduce the value of supply by issuing credit note. Alternatively, the customer, that is a distributor, can issue debit note, and the value can be reduced. Of course, subject to a condition that ITC to that extent also has to be reduced by the respective dealer. That is correct, and this discount will be reduction in price. The second is about the turnover for the month of May. It is only for 1 month that is been announced. So obviously, those who have achieved the target, they know the value is reduced. Here, there is no formal contract, but the message was conveyed through email. I think, in my view, the contract need not be something like on stamp paper, etc. What is more important, this arrangement is established much in advance. That is what the law is envisaging, before or at the time of supply. So here the email is going before May, and which can be proved, and it is scheme been announced. So there also you can consider it as a reduction in the price, and there should not be any problem in reducing the amount of value of taxable supply. The only thing, can one argue that agreement can be oral? Yes, under the Contract Act, oral agreement is also had a sanctity of law. Only thing, it will be very difficult to you to prove. Evidence of that will be very difficult in court of law, and that is up to you how you will demonstrate and prove it, that itself. But otherwise, oral agreement is a valid. I will advise you better to have a written agreement which can be proved or produced as a proper evidence in the court of law. As regarding the cash discounts are concerned, in my view, this is also announced well in advance, and it is all happening of the event. If the customer makes the payment within 1 week of the invoice, rather waiting for 2 months, he will be eligible for 4%. I think that is also reduction. It is allowed to be reduced from the value as per section 15, subject to reduction of the credit by the recipient, and that is possible. So incentive trade discount offered is not a separate activity at all, because the customer is concerned, the dealer is concerned. Dealer is not being, it is all indirect tax. It is a customer centric. It is taxing the goods and service. So it is a customer base. In entire transaction, the customer, the dealer, was never expected to render any services. The transaction is that it is a Balaji wafer who wants to increase his own volume. So there is no question of any activity being carried out by the distributor for the manufacturer. So there cannot be the interpretation of the auditor that it is activity and 18% GST to be levied by the distributor is not correct view, and therefore it is the only thing. It's a reduction in value of supply by Balaji, and not the activity is not liable as a service by the distributor to Balaji. To support this, there are decisions in the old regime where the law almost was on same parity under service tax regime. One or two decisions I have quoted here, one of Mumbai and one of Delhi, that is a MyCar Private Limited was Delhi, and for Mumbai it is Sai Service Station, which was more related to car dealers where the discounts were being given. Discount is nothing but reduction in the value and it is not for the promotional activity as held by both the tribunals in both these cases. No tax is leviable on the supply of the marketing services. Well, friend, the issue number 6 thereafter is about the GST charged on the exempted goods. That means the goods are exempted. To exempted goods means no tax has to be charged. But still the supplier has charged the GST, even it is exempted. What will happen to the ITC is a specific issue here. Now take the example here. There is a company called RBL, Rice Bran Limited. They are supplying the dal and pulses. While supplying these dal and pulses, these products are unconditionally exempt from GST. In the month of July 22, if you recollect, there were amendments. Then when you sell these products under the brand name, trade name, in the packing, etc., as the case may be, then it is leviable to tax at the rate of 5%. There was a lot of confusion amongst the professional as well as the trade. So therefore, this RBL on a safer side, what they have done is, in spite it is exempt or no, they charge 5% while supplying these goods. The one of the customer was ABC. To them, they have charged 5%. This ABC is a manufacturer of the sweet. And on the sweet, he is paying GST. The moment on raw material, that is dals and pulses, the vendor has charged 5%. What he has done, ABC has taken ITC of the same. And after that, they have discharged their liability. Then further, RBL is concerned, has also paid 1 lakh rupees for the input service on certain supplies. Say, let us say transport, GTA. Now on that, they already paid GST, okay, for this input, which was used for the purpose of supplying of these exempted goods, okay. Now in that case, they have paid GST and they have also availed the ITC thereof, because on the front side, on the forward charge, they already paid 5% GST on the supply. The question here is concerned, would ABC, the sweet manufacturer, will be eligible to claim ITC of the tax which was paid on purchase of unconditionally exempt product? Very important, this is unconditionally. These particular products are unconditionally exempt. What was taxable is only those products which are sold under trade name, brand, or on a pack, this thing. This was never been sold. So there is a completely unconditional exemption. The second is whether RBL is entitled to claim ITC of the GST rupees 1 lakh which was paid under RCM on a service which was input service, which was used for supplying this so-called exempted good on which they have wrongly charged GST. So whether they will be entitled for no. I hope the question is clear to that extent. With this, let us see what are the views from my side on this. First of all, section 16(1), which say that the ITC to be taken or whether it will be availed for input tax charged. Okay. Now, section 2, subclause 62, which define what is meant by input tax. And the definition is running into so many subclauses, which says that there are 5 subclauses, that is in relation to registered person means CT, ST, UT, UGST on any supply or good service, etc. And it includes the tax, mark this word clause B and D. B says that the input tax means the tax payable under the provision of subsection 9, 3 and 4. So that means something which is payable under 9, 3 and 9, 4, that is one part, is called input tax. And secondly, tax payable under the provision of the respective state SGST law. Now, mind well, in this case, whether tax is payable or no is very important. There is a difference between paid and payable. Now, here RBL is concerned, he has paid it, but that was never been payable. It was exempted. And that is how this issue is cropped in. So the question is further is, what is mean by central tax? It is a tax because credit you get that of central tax, and that is a central goods and levied under section 9. Now there is a circular in the old regime, that is excise regime, relevant to these kind of issues. Now we can draw analogy from that. Let us first understand what was the circular which was issued by the CBEC those days under the excise, and that was 940 number circular, which is very, very important. In this circular, it is stated that the board circular of 2010 issued by so-and-so wherein it was opinion of law ministry was sought, and whereby it was clarified that in view of a specific bar provided under subsection 1A of section 5 of Central Excise Act, this is very important, read this, the manufacturer cannot opt to pay duty in respect of unconditionally fully exempted goods, and he cannot avail Senway rate of the duty paid on input. Very important, this is it, unconditionally fully exempt. Those days we have used the word manufacturer because this was excise. Now we are talking about a GST. We talks about the supplier, dealer, etc. SSE. So ultimately, analogy is something which is unconditionally exempt. You cannot make it taxable and collect the tax in that extent. And if you have done it, whether it will be taxed, it is further clarified in circular is, in case assessee pays an amount as excise duty on such exempted good, the same cannot be allowed as a Senway credit to the downstream menu. That means when you charge wrongly there's such kind of duty, then that will not be allowed as a credit to downstream into your buyer, as the amount paid by assessee cannot be termed as a duty. That means what you have collected is the amount under the gauge of taxation, tax, but it is will never partake the character of the duty because it was never leviable under this law, and therefore it is refundable also, mind well. So duty is when it is defined under rule 3 of Senway rate rule. This is not the amount payable. Same way we can draw the analogy in our example. The goods were exempted by levying GST. You cannot make it taxable when the goods are unconditionally exempted. Further, the circular says that the amount so paid by the assessee on exempted goods and collected from the buyer by representing it as a duty of excise will have to be deposited, something which you have collected because you are trustee of the government, whether it is rightly or wrongly collected. There is a section 11D which says that you need to deposit to the government. So Senway rate of such duty, further circular says that Senway rate of such amount utilized by the downstream unit also need to be recovered in term of rule 14. So that means what happened? The tax wrongly collected by the supplier also will go to the government. Office credit also will not be eligible to the buyer. In our example, what will happen? There is no penalty for tax wrongly collected because he has paid. But there will be buyer who got a wrong ITC of that, which will be reversed by the government. They will ask for reversal. It will be recovered from them with interest and penalty also, perhaps. So, but in spite of this circular and all, to the surprise, the courts have consistently held in such cases in the old regime that such moderate credit you will be eligible for it. One or two case laws I have quoted, one of our Honorable Mumbai State in the case of a Guwahati carbon, and where it has been revenue has alleged that the appellant has availed ineligible Senway rate since supplier Guwahati carbon has paid excess duty. Mind the only difference here is concerned, the duty was leviable, but it was at a lower rate, and instead of that, Guwahati has charged at a higher rate. So suppose the duty rate is 5%, they have charged 12%, but otherwise it was taxable. There is a difference. So therefore, thereby it has been stated that you are entitled for it, and there are similar decisions of Hindalco also. An important observation of the tribunal is input suppliers assessment cannot be changed at the recipient end. This case is not exactly the same which our issue is concerned. In our issue, the tax was collected on exempted goods. Here, goods were taxable, but it was collected at a higher rate than what it was notified, than court says. Let us see one more decision, and that is the Punjab and Haryana High Court in the case of VG Steel, where it has been stated again same, duty was collected in excess of what was payable. The tribunal says, yes, you will be eligible. So there is a slight difference between these two. In both the case, there was no exempted transaction. So recipient is not required to know the law as applicable to the supplier. So whether goods are taxable or not, that supplier has to decide. Recipient is not expected to know that. Now section 2 subclause 62, which define input tax under GST. The tax which is payable under the provision of subsection 9 and 9.3 is concerned, If it is payable under 993, then only it will partake the character of input tax. And in my view, there is no question of getting ITC. That is what, in our case, if wrongly Rice Bran has charged the tax, the sweet person ABC Limited should have claimed refund of the same if he has borne the incidents, rather claiming ITC. That is what is my view in this example. Well, as regarding the RCM liability is concerned, on the exempted goods, it has been utilized by Rice Bran, so that ITC also is incorrectly been used, and therefore he cannot claim the ITC because it is used for supplying the exempted goods. So it is advisable to claim the refund of any such excess amount of tax paid rather than going for ITC claim, which is definitely a litigation pro, and the circular is against us in the old regime. In the new regime, we don't have any such circular. We can very well draw the analogy out of that. With this, friends, let us go to issue number 7. Coordinators, we are almost at 8. I can extend it by 10-15 minutes, sir.
Yeah, sir. Sure. Sure, sir.
I have 3 more issues. I think it will take another 8 to 10 minutes, and thereafter, if any questions, fine. So issue number 7 is about the sale in the loss. Sale in the loss, in the sense the you are purchasing at price X and selling at Y, which is much lesser than the X procurement price. So if you make a loss, whether you will be entitled for the ITC. These are the very commonly type of issues which we find in FMCG and retail segment. Now, here's a company called Max. They are in the business of selling computer printers. Now, all these electronic goods are concerned, they are all technology driven. They become outdated very fast, and the value is concerned, it reduces as the technology. Like mobile, you have seen the series 1, 2, 3, 4. A new series comes, and the value of old mobile phone is concerned, outdated, is going much below the cost of production also. So same thing here is about the computer printer. Max Limited is a manufacturer. Now, they sold certain model of printer to the distributor for 8,000 rupees and plus GST. In turn, the selling price by distributor to customers 10,000 rupees. Now, over a period, due to technology upgradation, the stock of these particular computer printers remain unsold. And now, because of the new technology, there is no buyer, or there are not many buyers for this. So, realizing that, Max Limited has announced one scheme. They have told all the distributor that instead of selling at 10,000 to the ultimate customer, please start selling at 7,000. Now you purchase from me at 8,000 and I'm asking you to sell at 7,000. Forget about your profit is a cash loss. So in turn, to compensate, they say that we will pay you 3,000 per piece. Okay. So that means you purchase computer from distributor, manufacturer 8,000. You will sell it to the customer at 7,000. And for every piece you sell, I will give you back 3,000 rupees. So you are not at a loss, but my machine is also being sold out. And I have also, the losses are concerned in borne by the producer. That is what the transaction is. The loss of 3,000 incurred by dealer is made good by Max Limited by issuing the credit note. I am giving you credit note. Now, in this case, the department issued show cause notice to the distributor, alleging that when distributor is selling it for 7,000 rupees to the customer, they have charged GST only in 7,000 and paid it to the government. Department said, no, you'll have to pay GST on 10,000. You have to raise the bill also of 10,000. Only thing and pay GST on 10,000. Out of 10,000, 7,000 you collected from the customer and 3,000 you have collected from the producer. Ultimately, it is nothing but a sale at 10,000. You as a dealer has nothing to lose. Who pays to is not very important. That is what the allegation of the department while issuing the show cause notice in this transaction. So there is a shortfall of payment of GST to the tune of rupees 3,000 value that department has issued. Now, what is the view? In our case, I agree with it for this reason that this is not a 3,000 is not a reduction. It is not an incentive whatsoever. It is just to ensure that the product which has become outdated does not remain unsold in the shelf. Rather, it is being sold out. So what I am doing, this particular scheme is announced by me to ensure that my stocks are sold out before they completely become outdated. And that's why I have decided to take a hit. And that is a call taken by the manufacturer. And that is why the manufacturer has come out with the scheme. Now, for this, there was no agreement, obviously, before the supply has happened, because nobody knows that when the goods will become outdated and when they will have to roll out with such kind of schemes. It is only as and when they realize the market condition, they come out with the scheme. So section 15.3 related to valuation is concerned will not be applicable because there was no agreement of such kind of reduction of 3,000 at the time of supply or before supply. It is afterthought, a business decision was being taken. So in support of that, I really don't refer much of the advanced ruling, but this one advanced ruling I'm referring in my presentation, which in my view is absolutely carrying the same ruling, which I also concur with the views given by the authority here. It is in the case of Santosh, distributor of Kerala Advanced Ruling Authority of 2019, where it was held that such kind of additional discount given by the supplier through the applicant, which is reimbursed to the applicant, is to offer a special reduced price by the distributor to the customer, and hence the amount represent consideration paid by the supplier of goods or principal company to the distributor for supply of goods by the distributor to the customer, exactly the one which our case covers. Therefore, the ruling authority says that this additional discount, which is reimbursed by the supplier or principal company to the distributor, is liable to be added to the consideration payable by the customer, and tax has to be paid on entire 10,000. So in our example, the 3,000 rupees damage is that of principal. It does not affect the selling price of the distributor, which still remains 10,000. So they will have to raise the invoice of 10,000. They will have to charge GST on 10,000. They collect 7,000 from customer is fine. Other 3,000 comes from the producer, and tax has to be paid, and the show cause notice issued by government is correct to that extent. With this, we'll go to case study number 8, and that is on the expenditure on sale and distribution. There is a company called Britannia. For the purpose of marketing, they incurred various expenditure on sale and distribution. It is registered only in Maharashtra, and they send their salesmen and employees to different states across the country, all over the India, for promoting and marketing of their products. These salesmen would travel across pan-India, incur various expenditure on account of staying at hotel accommodation, food expenditure and beverages, traveling, etc., and get the same reimbursed. I assume that all these invoices which the salesman has taken from the supplier of service are in the name of Britannia Industries, having Maharashtra address as well as GST number of Maharashtra. The question is whether Britannia will be eligible for the ITC of various such expenses of that of hotel stay, food, traveling, etc. This is very common in FMCG and the retail segment also, and the issue is that, let us take one by one our view. First of all, section 16, there is no bar which says that every registered dealer is entitled to take the credit for the any input service which are used for or in the course of business. Obviously, there is no bar in section 16.1. So traveling, food, beverages, accommodation, everything they will get ITC subject to condition 16.1 and 16.2. The only problem thereafter it comes is what are the expenditure incurred, whether there is any block credit. So therefore, you have to go to section 17, and for it is hit by section 17.5b, which restricts the credit of ITC of food and beverages. So in our example, the food related expenditure is concerned, will be ITC you will not get because of section 17.5 is concerned. The other is accommodation in the hotel and the traveling is concerned. There is no bar in section 17. Further is concerned, ITC on traveling, yes, they will be eligible for, and there is no restriction. ITC and hotel, there is no restriction. But the only problem is concerned when the hotel is located within Maharashtra, there is no issue. But when it is located outside Maharashtra, the place of supply will become out of Maharashtra because the location of the hotel, and therefore the Britannia is not registered in that state. So it will be very difficult for Britannia to get the credit of SGST of that state. As regarding CGST is concerned, there is a good case to argue. Of course, department doesn't allow that credit, The matter is not free from doubt. To my knowledge, there are petitions are pending as about the credit for CGST is concerned, but SGST, we are on a weaker footing in this case. The next issue is the redemption of the point. This is the last issue of the day, and that is when it is a loyalty point. You have been going to various stores, lifestyle or the Starbucks or so many such retail counter stores are there, shopper stops, and where there are loyalty points being given to the customers. What about the taxability thereof? So here is one example. A lifestyle is concerned. They have come out with the schemes where thereby it has been stated that they introduce offer in the month of March 23, whereby it has been stated on each purchase of rupees 100 from that store, the customer will get 5 reward point, loyalty point. You can give any name to it, no, doesn't make a difference. These point can be redeemed on the subsequent purchase within certain time limits. And each point is equal to 1 rupee. So in nutshell, for 100 rupees, you get 5 rupee, but it is coming by way of a point, which can be redeemed in the various lifestyle store within certain time limit. The question is, Mr. A has purchased 10,000 rupees worth goods in March, so get 500 reward points. In the month of April, Mr. A bought a belt worth rupees 600 from the same store, and he redeemed 500 against it. Obviously, he has to pay only 100 rupees. The question here is concerned is what is the GST applicable on the reward point or the voucher given to customer. I have taken both, whether it is reward point, loyalty point or voucher, the treatment by and large will be same. That's why whatever nomenclature you use, that is given in the month of March. And the second issue is concerned on what value lifestyle will charge GST to March when they sell belt worth rupees 600, on whether it is on 100 rupees or on 600. Because the belt was sold at 600, but they could only recover 100 rupees because 500 worth rupees of voucher being redeemed. I hope the question is clear. Let us take the analysis of this. The first is the section 2 subclause 118, which defines voucher. Very important, this definition is. It says that an instrument where there is an obligation to accept it. So whether it is voucher or loyalty point, there is an obligation is there. As consideration or part consideration for supply of goods, service or both. And where the goods or service are both to be supplied or the identity of their potential customer are either indicated on the instrument itself or in related documentation, including the terms and conditions for use of such instrument. So in my view, our loyalty points or voucher or whatever is being given coupon, it will fit within the definition of voucher as defined in 2118. In an instant case, reward point is nothing but a voucher. Now, section 12 subclause 4 is the one which is very important to determine the time of supply. And this talks about time of supply of the vouchers and not of the reward point. Now, here what has happened is, I have stated that reward point is nothing but a voucher in this case. It is depend how you, what are the terms and conditions attached to it. There are two types of voucher. One is you pay some amount and get a voucher which can be later on gifted, endorsed, utilized, whatever, redeemed. And second is a reward point. You need not have to pay anything, but you have to buy the product to qualify, and thereafter the reward points have been granted. There's a major difference. And the time of supply is concerned for reward point and voucher to that extent which you make by payment of cash will be different. In 12 subclause 4 of CGST, the time of supply says that in case of supply vouchers by supply, the time of supply shall be the date of issue of voucher if supply is identified at that point. What is meant by identified? That means this voucher can be encashed or used for buying a specific product only. If I put, you can use the voucher only for buying shirt or buying pant or perfumes. If it is known well in advance, only one product or specific product, then time of supply happens at that point because the rate is known. But when it has been stated that you can use the voucher for redemption against any product which is sold in the store, then there is no time of supply because you don't know which product you are going to buy. So how to pay the tax? Rate may be different. So that's why it says that subclause B, the date of redemption of voucher in other cases. In our example, the lifestyle voucher, he can redeem against any product. So there are so many products available in lifestyle carrying different rates. So there will not be a time of supply when the voucher is issued because it is not known what for it will be redeemed. There is no supply and voucher is not a goods mind well. Voucher is neither goods nor service. but it is only because the advance consideration, if received, then only time of supply arises. In the instant case, while issuing reward points or voucher, supply against said voucher cannot be identified. Therefore, GST will be payable only at the time of a redemption. That is my view. And the next is voucher reward points are nothing but a currency. With a limited this thing, that is it is which can be exchanged or used only for purchase of good within the lifestyle store. So this is not like our currency, a novel currency which is valid across India. This currency is only valid within the lifestyle. So you can say currency which is valid only in lifestyle is a voucher. So lifestyle is concerned, what they are not in the business of selling currency. What they have done, they have sold the belt for 600. So supply is there of belt, and therefore goods has to be charged on 600 rupees GST. They have charged whatever is applicable to the belt, whatever rate. Assume the rate is 18%, they will charge 18%. And then while collecting the money, they will give credit for that 500 rupees equal to the voucher, and net amount they will collect. I hope this is clear. Well, friends, within the time allotted, what all best case studies possible, I tried to take you through those case studies. If you have any issues related to the topic per se, with the permission of the coordinators, we can proceed. Pooja, is there any issues in Q&A box?
No, sir. I can see the questions for past period only. But one of
Okay.
the attendee had raised hand, which
Yeah,
is Mr. Rajendrian, sir. Sir, would you
yeah,
like to ask
yeah,
any question?
yeah. We let us allow them. Let us allow them.
Yeah, yeah.
You can unmute and you can ask the question, sir. Hello, is he there or disconnected?
Sir, he's there, but somehow I cannot connect with him. So, yeah, I can see in team a lot of participants are. Uh, I mean, they are. I think they're much clearer on the topic since the topic was explained in such simplified manner. So, I did not see any specific question, but I have one question if I can ask.
Yeah, yeah, very well.
So, sir, the last point which you raised regarding the voucher. So,
Yeah,
voucher at times comes with a condition that you can only buy X kind of product or a Y kind of product. So,
correct,
in that case, but again, that can be bought within a particular time limit which has been given
correct,
in the voucher. So, in that
correct.
case, how would we consider point of I mean time of supply?
Yeah. So, Pooja, now suppose we assume that in our example, the lifestyle voucher is being given, which you can use only for buying, say, ready-made garments, only garments. Suppose that is a condition given. Now, and assume that the rate of GST is 5%, which is known at this point of time on the garment. And now, what is the time of supply? You look at the relevant slide, which is a relevant section 12, subclause 4. Time of supply is concerned, it says that there are three events in every transaction of supply of goods or service. One is that of supply of goods or service per se. Second is receipt of consideration. And third is the raising of invoice. These are the three events happen with every transaction of supply and goods. The time of supply says that whichever event happens first will be your time of supply. Okay, in every transaction, these three events happen. Now, in this example, what has happened is I told you that there are two type of voucher. One voucher is by way of a loyalty point, and the second voucher is one which you can buy by paying the cash. So time of supply 12.4 will be applicable only when you buy it by paying something, because consideration is paid for voucher. In the loyalty point, there is nothing is paid by you, but the point has been given to you and it is credited to your account. It is possible that you may not use it also, Pooja. You may
Yeah.
not redeem it. There is all possibility. So there is no time of supply of such kind of loyalty point unless it is been utilized. But as regarding the payment made across the counter for purchasing the voucher of lifestyle, you have paid the consideration. Now there are two possibility. There may be possible you are a rich lady, you may not utilize that voucher also, even after being paid. Or sometime your time is lapsed, it become expired also. And sometime you may use also. It can be anything. But what happens is, when as a lifestyle, I receive 500 rupees today, and I have stated that you can use only for the garments, the rate is 5%. The section 12 subclause 4A, which says that in case of supply of voucher by supplier, the time of supply shall be, that means no choice, the date of issue of voucher if supply is identifiable at this point. So I can say that it is identifiable today only that you will be buying only ready-made garment, garment, nothing more than that. So the rate is 5%. On 500 rupees voucher, I'll pay 25 rupees. Now assume that after the validity is 2 years and you come for redemption after say 9 months. And at that point of time, you redeem entire 500. There are two possibilities. Either the rate of garment is more than 5% or less than 5%, or it is equal to 5%. Okay, assume that it remains 5%, it remains the same. Then what happened? You purchased a garment for 3,000 and on that 3,000 supply of goods have happened. So I will pay 3,000 minus, I'll levy tax thereon, which is 5%, less the voucher on which tax is already paid and given as a redemption. So 500 rupees plus GST I have charged today 25 rupees 5%, and that's how you pay balance amount that point. That is one way. Suppose the rate is reduced, then whatever rate is there, accordingly I'll give offset. And last thing is, suppose the goods have become exempt at that point of time. So now ready-made garment you purchase for 3,000, there is no GST on that. So there is no GST on supply, but you already paid 500 rupees ke upar GST today. So that the GST portion, it will be refundable to you if you claim refund as a customer because you have claimed the incidence. Alternatively, Lifestyle can pay you back the tax amount and they can adjust this tax amount in their supply of other tax this thing. So both way, it's all depend upon how you are, we are falling into which particular permutation and combination. But that is what is the time of supply.
That solves my query. Thank you so much, sir.
So thank you very much. Thank you.
Okay. I do not see participants have any query. So yeah, I would say thank you very much, sir, for this wonderful session, because each and every aspect which we face in day-to-day life, especially FMCG and retail, we are close. Every one of us is connected to that. So every point was taken very clearly, and it was in very simplified manner. The day-to-day examples which we can connect with. So overall, amazing session, sir. We got a lot of inputs and insights on the matter. So I would just like to thank you for that, and it was wonderful having you. And yeah, for the participants, we will definitely share the PPT once the through WRC, and we will definitely share the PPT to everyone. Surely, yes, sir. So I think, sir, we may conclude the session.
Thank you. Thank you
Yeah.
very much, Pooja, for giving an opportunity. And I hope it was useful to the participant. You already announced, and I'm again telling you, the entire PPT I'll be forwarding to WRC. WRC can thereafter take a recourse of distributing or uploading on the website as the case may be. So thank you to the organizer once again. Thank you for Pooja.
Thank you
for
so
your
much
kind
for
words.
thank you so much, sir, for your valuable time. Thank you
Thank
so much, sir.
Thank
You, sir. Yeah.
So I'm disconnecting, madam.
Sure, sir. Sure, sir. Thank you so much, every participant. Thank you very much.
Bye. Bye.
Yeah. Bye. Bye. Thank you, sir. Thank you.